So, guys, let me take a moment to introduce our guest. Although he doesn't need an introduction, a very popular and familiar face. So, today we have with us Sahil Sharma, a senior software engineer at Google. Have been working with Google for over 5 plus years, and by education, he did his dual degree, basically BTech and MTech in computer sciences and engineering from IIT Madras, and that's a very reputed institute. Everybody is aware of that. And Sahil firmly believes in direct investing. As per him, like mutual fund investing is a good way, but again, that doesn't suit him because he believes that if you are working hard, you should deserve an alpha over the index investing. So a very warm welcome, Sahil. And if I missed out something on your introduction, would be great to hear from you. Over to you, Sahil. Sahil, you are mute, I guess.
Yeah, sorry, I was on mute. I was just saying that nothing much to add. Thanks for the introduction, and yeah, I think we can get started if you think that's okay.
Yeah, yeah, great. So, Sahil, it would be great to know like everyone has their side of story when it comes to how it started for them. So, as far as investing is concerned, like how it all started for you and how it has developed over a period of time.
I think starting point was that uh, I used to work at Google and get paid monthly, and typically all that money would just lie in a bank account. In fact, it was HDFC bank account. Savings rate of like 2% or whatever, very, very low savings rate. Uh, in some in some cases I might create some fixed deposits, right? But I didn't have too much of an idea. But one interesting thing which happened with me, one of my friends at Google told me that his father is a government employee, and that all he did was to invest in mutual funds systematically for decades. And that, through that, he was able to build a large corpus, right? And that actually just blew my mind that, all he did was just invest money in a mutual fund, which is like a commoditized product. There's nothing special in it, right? Anyone can do it. And with Paytm money, and like, not that I am associated with Paytm money in any way, but I'm just taking an example. Paytm money, you can put 100 rupees also, right? Even our house helps can start investing if they want to. So my point is like that really, really made me sit up and take notice that, okay, something is happening here. Like, how can it be that people can create a large corpus with a government job? And my own father works in the government, so I know that the government job doesn't pay well, or more like, until 2008 9 it didn't pay that well. Like the latest or the second to the last, uh, I think it's called like pay commission. So government employees get a pay hike every like 10 years or so, like a very significant hike. But before the 2008-9, they were not paid a lot, right? So I knew that they're not paid a lot, and yet he managed a large corpus. To me, that indicated that there is something to be studied here, basically. From there, basically started exploring like what are the ways to invest, stuff like that. I figured out there are mutual funds. I started by investing on HDFC Bank directly, and those are of course regular mutual funds. Eventually, I realized that, oh, they are charging some commission from the distribution, and that, there are these direct funds on Zerodha. So then I, shifted to Zerodha. And in doing all of this, the burning question that was always in my mind is like, how can I select, right, which fund or like what to buy? I could see that the funds actually move around a lot in terms of performance. The one who has the best 5 year performance may not be the one which has the best 1 year performance, may not be the one which has the best 10-year performance. What that indicated to me is that just looking at past performance may not be a good way, because it keeps shuffling around a lot, right? It's not like the same fund is the best for the last 1 to 5 and 10 years. That's rarely the case. So then I started looking at their holdings, right? What I realized is that they have like 100 holdings, many of these funds. So then I started thinking, okay, then how do I figure out if they're holding the right companies or not, right? Um, I also realized then that, mutual funds change managers every like few years. So it felt very difficult to figure these things out. So that's when I started, going to some of these websites, like this one called Money Works for Me. That was the thing I used before Screener. I didn't know that Screener existed. So I just, wrote some code to scrape data from Money Works for Me and built like my own screener basically. And I used to screen for companies. I found companies like Kaplan Point. I found Yes Bank. Of course, at this point, I was very naive, noob, however you want to look at it. And it was probably around 2018, and so forth, right? So slowly from there, I think the biggest step jump that happened in my journey was discovering the forum value picker. Because when you discover value picker and you go through even one company thread, that is when you realize like what does it take to do direct investing, right? To do it properly, professionally, not as a amateur or based on tips, right? So that was the starting point.
That's great, Sahil. So, Sahil, if we were to ask you what is your investing philosophy and what is your sphere of investing, having said that sphere, as in is there any specific, say, micro cap area where you specifically look for companies, or the company has to be good is the only criteria which you look for?
So I think yeah, that's a good starting point. And actually, I think now that we have like formally started, I think best is to start with some disclaimers that literally everything I share in this spaces and also in general on Twitter is never to be construed as investment advice because I'm not a SEBI registered investment advisor or research analyst. I'm just an individual investor who is sharing his experiences, and they should be just taken as that, as a sharing of experience and as a way for someone else to learn, right? Not as a way to just copy paste or just follow it directly, right? Because I'm not giving anyone any advice. So, with that out of the way, to answer your question on like, how do you invest or like how do you uh, figure out? So I think like I want to take a little bit of time on that. I had shared a sheet, right? And I hope that people have looked at that or they are looking at that. Um, if they might not have seen that tweet, let me, tweet it out just right now, so that, people can see it if even if like they might have missed the other tweet. But what I want to draw people's attention to is the fact that we have to very, very systematically estimate businesses on different dimensions. And then we were able to figure out like, does it make sense for us to invest in them or not? Now, what are these dimensions will of course depend on the type of investment we want to make. For example, the dimensions I'm looking at, if you look at the sheet, column O is earnings CAGR, then column P is moat. Column Q is valuation. Column R is TAM, right? I've just added four columns for demonstration. But someone else might add another column for, management quality or promoter quality and so forth. Point is, I think it's very, very important to be systematic about these things rather than being arbitrary ki chalo acha lag raha hai to le lete hain type, right? Because then you're just building a zoo. The other thing is, I say this a lot that like my sole focus is on my XIRR because I think I'm still a very small investor. I don't have, thousands of crores to manage like mutual funds. So I can't tell you high-handed knowledge of, buy and hold it for 20 years and stuff. If I had a large corpus, I might have given you that gyan. I think for a small investor, it's very, very, very important to know themselves and know like what are they seeking. So my point is like look at any business. For example, look at Loris Labs, look at Sequent, look at Angel, look at Webhub. Whenever the business cycle turns, it's a very painful 1 to 2 year period. While the business may not go away, the business might just slow down, right? I mean, for example, Webhub Global went from 25% growth to like roughly 0% growth. Now, it's not that the business has gone away, but because the slowdown from 25% growth to 0% growth, and because generally in the small and mid cap space, everyone is a growth oriented investor, the rating will fall like anything. The PE multiple, it would go from like 60 times earnings to 15 times earnings. And that is how you see like a 60-70% cut in price, right? Now, the point is, should you sit through it or not? Now, I think the most important thing that one has to understand in investing is that there are no right or wrong answers. There is no one answer fits all. It really just depends on your style or what you want to accomplish through your investment process. There are people who would happily sit through, they would average down, because they claim that they have really good business understanding, right? And maybe that works perfectly for them. And there's something that I have to learn there. But my thought process is I'm still not a very experienced investor. I have maybe like 3 years of experience only, right? So I should probably not overestimate my ability to predict the next 5 years for the company, right? I don't want to overestimate it. What I know today is that the business growth or the thesis has broken down today. I want to act on that information, right? Not to act on the hope that, okay, maybe 3 years later it will turn around, right? I don't want to act on that because the beautiful thing about the auction based markets is that one can always come back, right? It's not that I have written off these investments forever. What you can, for example, see in the sheet is that, I have modeled Saregama. I want to model Webhub. I want to model Newland. I want to model Loris. These are companies I don't own anymore, just as a disclosure, right? But that does not mean I'm going to throw them away. I'm obviously going to still monitor them because I think as a business, they are very interesting. Just that I don't want to own businesses which are going through significant headwinds, which might last for a few years.
Yeah, great. And like Krishna and Ravi, in between, please feel free to ask if you have any question to Sahil. So Sahil, like, what criteria or what screener do you run so as to? I mean, first of all, like, would appreciate if you tell us how you generate ideas, and if you have ideas, so how you go about converting it into an investment going forward.
So I think that's a brilliant question, which is, how does the funnel work, right? I think like the couple of things are very important here. Like number one step, even before we come to ideas, is we have to know what we are looking for, right? There are 5,000 listed companies. If you really just want to own everything, and I think this is a brilliant point which Professor Bakshi made on a podcast, which is like basically there are no bad ideas, right? One of the good ideas is say no to 95% things, right? That is what I practice. The opposite of that can also be a good idea. For example, you might buy NSE 500, which is like 93% of the market cap, and you might do well with that as well, right? Owning all of NSE 500. But let's start with the assumption you don't want to own NSE 500, right? You are going to own a few businesses. That few will be something that you as an individual investor can track. That will typically be, between 15 and 50 or maybe 5 and 50, right? Typically, I've not seen individual investors own more than 50 companies. It becomes exceedingly hard to track more than 50 companies. I personally think like 15 is my limit, like 15 to 20, but for some people, maybe it's 50. Now that you know yourself, that, I want to own, let's say, 15 companies, then the question becomes, how will you find these 15 companies? There are 5,000 listed companies. I want to own 15 companies, right? Now, the important thing to understand is understanding a company in depth will actually require a few months. It is not a simple or straightforward procedure, right? Any company you pick up, you are going to have to do a tremendous amount of research around it. For example, if you look at this company called Gujarat Fluorochemical, right? They make these things called fluoropolymers and refrigerant gases, and they are basically one of the largest fluoropolymer makers in India. And even at a global level, they have like 10% market share in the largest fluoropolymer molecule, which is called PTFE. Right? Look at Gujarat Fluorochemical. Just to understand Gujarat Fluorochemical, I have had to understand maybe 5 companies around it. I have to understand SRF because SRF is the leader in refrigerant gases. Gujarat Fluorochemical also makes refrigerant gases, right? And in fact, refrigerant gases are an intermediate that go into the fluoropolymer. That's why you have to understand. Then you have to understand Chinese competition. Is there a risk that China may dump these same chemicals into India, right? Then you have to understand the MNC or the global competition, like Solvay, like Chemours, and Arkema, right? These are just some names I'm throwing around. But my point is, for understanding one company, you have to actually understand 5 companies. Maybe not in as much depth as your core company, but to some level of depth, right? Because of that, basically, there is a lot of work which has to be done. This can easily take more than a month, right? I think it should take more than a month. Like we are not in any hurry to, either make up our minds or to make up a position, right? So the point is, given it takes so much time, any person can realistically only deep dive into something like, I think, a maximum of like 50 businesses in a year, right? This is assuming you're doing a few in parallel, right? I think 50 in a year is like a very, very upper limit, right? I think it's very hard to do more than that. 50 in a year is like one a week, right? And then I'm assuming you're sort of parallelizing it a bit, studying over many months and stuff. The point is you have to study 50 businesses. Now, how will you figure out which ones to study? Because after you study, then you will figure out which ones to own. So I think again, it pays to know yourself as an investor. Like, what are you looking for, right? These screeners, for example, that you talked about, only encode what we want to look for. So, I mean, there are different types of screeners we can create. We can create screeners for turnaround companies. That, I want to screen for companies which are turning around. Earlier they were not doing well and today they are doing well, right? Those are turnarounds. Then you can also say, I want to screen for companies which are actually consistently performing well over the years. That, it has done well in the last 1 year, 3 year, 5 year. And then whatever criteria you have, you can actually encode it into the screener and then look for companies like that. Now, one thing I want to point out on screener is screeners really do well in idea screening in markets which are depressed or bear markets. For example, I think one of my most fruitful thing I ever did was to run a screener in June 22. Sorry, June 20. June 20 was when, COVID thing happened. We were at the low. I was running screener. I could see RSCL at 5 p.m. Right? That is what screener would throw up. All you had to do was look for a company which is consistently growing sales, has a high ROE, right? And maybe I would also put some market cap limits and, up to 2000 crore market cap or something because I'm looking for a small cap or a micro cap, right? I would get a list of like 100 or 150 companies depending on what filters I put, right? That would give me the idea set. So I mean, I think once in like 6 months, what I would do is run some of these screeners. Let's say I get 100 companies, right? I don't have to read each and every company in a large amount of depth. All I need to do is number one, screener already has a wiki, right? The wiki tells me all I need to know about the company at a very, very high level. The second thing I would probably do is see if they have investor presentations. If they have an investor presentation, I would go through the latest one, right? Even if I have no context, just going through the investor presentation is often a good way to filter because in an investor presentation, at a very high level, the management is trying to summarize what the company does, right? That's second thing. The third thing would be I would look for a value picker thread. Does this company have a value picker thread? And if it has a value picker thread, that is the best thing that can happen to you as an investor. Because then you can actually summarize findings from, let's say, a decade in like 5 hours, right? It would not take you more than 5 hours to read, let's say, 500 posts because you're just doing initial screen, right? You're not going very, very deep. You're not reading the documents in the thread. You're just reading the thread to see how the evolution of the company, right? So, for example, for RSCL, I screen it, then I go to value picker. I read through the thread, and my eyes fall into my hands. I'm thinking this is such an amazing quality company available at a PE of 5 and a market cap of 70 crore, right? And that's when I decide, okay, then I think I need to put a serious amount of money into this. This can't be like a small investment because the odds are in my favor, right? So that's one way. You screen, right? I think screens work really well in bear markets or depressed markets, for example, June 20. And I think even the current markets sort of qualify. They sort of qualify. Like the valuations are getting there where screeners would help you. You may not get like a 5 PE company with moats, but I think you will get a company at like 10 to 15 PE with moats, right? You might even get some companies with checkered past at single digit PE, right? And then you have to decide where do you want to dip your toes, right? I personally think even a 20 PE is something I'm willing to pay in a very normal course of things. Now, I want to remind all our viewers that at one point in, let's say, 22 like maybe even December 21. This was a time when people were saying that a 30 PE for a specialty committee is too cheap. That is what investors are saying that 30 PE is too cheap. I was telling them that we should not compare, do a relative comparison and say that this is too cheap. So the logic that people were using is that other one is at 60, my company is at 30, so it is too cheap, right? I would never look at it that way because 30 is 30, right? 30 times earnings is not a multiple you should be very willing to pay, out of thin air. Like it has to have a very strong reason behind it, right? So, I mean, screener is one, right? Let's look at the second way. So I think one of the best things that a individual investor can do is to share their findings with the world. Because there's this beautiful thing which happens, which is when you share, people share back, right? That is one thing I have benefited from tremendously. I share things, I've shared my findings on companies, people send me DMs and talk about those companies. That's how I learn more, right? And I mean, in a similar way, when we keep talking to people, this network of investors that we build is tremendously powerful, tremendously important. And many people believe that network is net worth in investing because your network will tell you opportunities which you may not be able to screen for. That is the important thing, right? For example, if I know that this company will do well because I have talked to the management, right? Or a con call of the company has happened yesterday, right? The con call has happened yesterday. It is obviously not going to be on screener, right? In the numbers, it won't show up. The company might be saying that, things have turned around. We are going to do 25% growth, and maybe it's a very conservative management which has never guided for growth, and now suddenly they are guiding for growth. They have a good track record. Everything can fall into place. The thing is, we need to have the right network. That's how we will get to know about these things, right? So I think networking is very, very important, but networking should be looked at purely as a way to generate ideas. I would never put my hard-earned money just because a expert or some other investor has put their money into that idea, right? That I would never do that. And there are so many examples we can find where borrowed conviction leads to, 70, 100% drawdowns, right? I mean, this is really serious. People should never put their hard-earned money on borrowed conviction, or, just some ex-investor has invested, so let me also invest, right? That's not how it works. Because tomorrow, if there is a drawdown, then you will figure out what should you do about it. For example, if you look at Xpro, right? Xpro, when I started investing, was like, I think 650 rupees or something. Now they had a bad quarter. Price went to 550, which means there was like a roughly 20% cut, right? That's when conviction comes in. That's when you have to have a in-depth conviction and based on your own knowledge and research. Because that's how you will know whether my thesis is broken and I need to sell, or is my thesis intact and hence I need to add, or maybe I need to wait because the thesis has been postponed, right? Those are like the three rough things that might happen, right? So I think, yeah, those are the two things. And yeah.
So Sahil, like we should draw a line while analyzing a company, that how much research is needed and how much, I mean, because studying too much about the company brings in certain biases and that kind of stuff, and too much of information at times there is a possibility that people find it difficult to invest even if the investment is a good opportunity.
Yeah, I think you've made a brilliant point, which is like, how do we know when we are done, right? I think, again, the number one thing is you should know what you are looking for, right? I mean, studying companies is not like watching a TV show, right? So watching a TV show is for pleasure, right? I just randomly watch TV shows. I don't have any expectations from the TV show. I'll just randomly watch it. If I am studying a company with a particular goal in mind, then those are the specific things I'm looking for, and I will try to find those specific things. So let me maybe explain my framework a little bit, right? How I approach it. So I mean, one thing I have always looked for is, some uniqueness in the company. I want my company to be a unique company. I don't want it to be a me too company, right? If there is something which is done by 10 people and my company is also doing it, I don't want to own it. The simple reason for that is it is very hard for me to predict out of those 10 how the market share and the sales mix, I mean, the sales growth mix, the competitive intensity will evolve into the future, right? So, which is why I would always want to own a unique company. And just as an example of a company I don't own, look at TB FinTech, right? They're like 90% of the market share or something, like a very large number of market share in digital insurance marketplace, right? And that makes them extremely unique. And similarly, if you look at Titan, they're like the largest retailer of jewelry, right? I mean, largest at least from like profitability perspective, probably not from sales perspective. I think Malabar and others are more like they have higher sales, we don't have higher profits, right? My point is we have to find these unique companies. Now I want to add a very interesting point here, which is that I had this intuition for looking for unique companies, but it's only when I read a little bit of Michael Porter that I realized why that makes a lot of sense. So I'll just briefly discuss a very interesting concept, which I hope people will think about a bit. And I think it will have value and application in your own lives also, not just in investing, which is like, what is competition, right? If you intuitively think or ask people what is competition, most people will say it is trying to be the best, right? This concept of being the best, winning, being the first, being the largest, being the cheapest. This is how people generally think of competition, right? That I will be the best, I will be the largest, I will be the cheapest, and things like that, right? Now, the interesting thing which Michael Porter tells us through his work actually is that competition is not about being the best. Competition is about competing to be unique. What does that mean? That means the company must create a unique value proposition for its customers that their customers are happy paying up for, right? Let's take a few different examples here. if you look at the auto industry, right? I mean, one interesting thing which Elon Musk has said on this is that most automakers actually sell cars at 0% margins. They sell cars at 0% margins. They make money through the repairs and the ancillaries that they sell along with the car, right? Now, how do you actually break into this industry? How do you create a brand? Look at Tesla today, right? They have, I think, something like 29 to 30% gross margins. And I think their operating margins are higher than the gross margins of most car companies. Now, how or why has that been possible? That is because Tesla has not competed to be the best. They have competed to be unique. That is the important thing. They have created a unique value proposition for the customers, which is it's a completely electric company, electric only company. They have actually produced more energy through their solar sales than has been consumed by their cars. What that means is net, they have been energy generators actually, not consumers, right? Very interesting, unique propositions like that. Very fast electric cars. Nobody made electric cars the way Tesla made it until Tesla made it. Of course, once Tesla showed that it's possible, then everyone has copied it and come onto the scene, right? But then they don't have the unique value proposition. If you look at a Ford, if you look at anyone, let's say a Tata, right? Tata is selling electric cars. Does it have a unique value proposition? No, it doesn't, because Tata is selling your ICE cars also, right? Now, if you look at the interesting direction in which Tata is going, if you look at the new cars that they are designing, those might actually have a unique value proposition. The reason is that those are sort of born electric native, and they are designed to be futuristic, right? That's creating a unique value proposition. So I think this is a very important concept that everyone should deeply think about. That competition is not about being the best; it's about being unique, and through being unique, being able to create defendable, sustainable profit pools and capturing the profitability in an industry. Right now, let me give you another very interesting example that I sort of learned yesterday. Right, there are three refrigerant gases that I was sort of discussing with a industry expert about. Right, there is, I think, one is called R32, one is called R125, one is called, I think, R134A. Right, these are names of three gases. Then there are three companies, right? All the three companies actually specialize in one refrigerant gas each, right? They specialize in and manufacture and focus on one gas each. That means they are not competing with each other. They are actually collaborating. Now imagine an industry where they didn't collaborate but rather competed, where each of them started making each other's gases. What would happen? That is what Michael Porter calls like a race to the bottom, right? Where everyone is trying to make things cheaper, and then eventually all the value that you could have created for your shareholders, you just distribute it to your users, right? Initially, you might have thought that Geo was doing the same. Geo was giving free data to everyone, right? But eventually, what happened? I mean, actually, if you look at it now, they actually did that to some extent, right? They commoditized data. They said, let's, make everyone go out of business. We will be the only ones left. And of course, Airtel also survived because they are at that scale, right? But if you look at it, most industries, if there is a unique value proposition that companies have, ideally that is the kind of thing where you want to be, right? You don't want to be in a place where companies are competing only on cost, right? If it's just a cost based competition, then it's a race to the bottom. And I mean, let me give you some more thoughts. Like, maybe I'm wrong in it because this is not my area of expertise, but if you look at Loris, right, they had extremely high margins in ARV business, right? But again, the mode that people talked about is that they are the lowest cost producer, they are the largest producer. But actually, that's like a race to the bottom, because someone else will come, someone else will think that I will do this better, I will do it cheaper, or a Bindo SMS, many others will start making these same APIs. And that's how competitive intensity goes up. That's how the industry structure gets spoiled, right? So I think, just to come back to your question, I think we have to know what we want, right? Once we know what we want, I want unique businesses. Then I'm going to quickly look for the uniqueness in the business, right? I'm going to quickly look, is this the only company doing this, or are there other companies which do this? If I look at Saregama, they are the largest music catalog, right? And they are like the second largest by revenue, right? And this is an extremely concentrated industry where actually this particular player, which is Saregama, is capturing most of the value in the industry. Spotify is not capturing value, artists are not capturing value, Saregama is capturing value as the label, right? So that immediately makes it very attractive to me. Versus a random company like, I don't want to name any companies, but let's say there are these, forging companies, right? If you look at forging companies, it's very hard to find that they're doing something unique, right? Generally, they are competing with each other. So one of the forging companies I studied, the company themselves say that we have 10 competitors in India, right? And each of them are making products which are indistinguishable from us, right? That is not a place I want to be. Similarly, if you look at, a company which makes these PP chips and these, recycled plastic bottles, right? Without naming the company, because I don't want to speak negatively for any company, right? These are all very, very, very hardworking entrepreneurs, and they have my infinite respect, right? It's very, very hard to be an entrepreneur in India. So if you look at these companies, right, they are making these recycled plastic bottles, right? Now the thing is, if you look at it, so many other companies are making the same bottles. There is no barrier to entry, right? That's not an industry I want to be in. So I think the
So
answer
I
to your
think the
question
answer to
is,
your question is,
hey, sorry,
hey, sorry,
my voice,
my
Yeah,
voice,
yeah,
my voice
very,
is
very
my
looping a
voice
bit.
is
relevant.
looping a bit, but
Yeah, very relevant
Uh,
points made by Sahil, and these are all thought-provoking pointers you just made. So we got Malhar and Krishna with us. So Malhar, you go first, and then we go to Krishna and Santosh.
Hi Sahil, thanks a lot. It's always a pleasure to hear you speak. Uh, would you mind elaborating a bit on sort of your evolution of your thought process and how your thought process has evolved in terms of thinking about companies and also some investors who have influenced your style of thinking?
Hello,
Yes, I
hello,
can.
can you
hello,
hear me?
can you hear me?
Yeah, I can. So
Uh,
was Malhar audible to you?
Yeah, Mana
yeah,
was
Mana was
audible.
audible.
Just one
Just one
request
request
that if
that if
everyone
everyone
else can.
else can just mute because I'm getting an echo basically right now. Yeah, thank you so much, Prince Bhai. So, just to answer Malha's question, right? Evolution as an investor and which are the investors who have influenced me? I think evolution as an investor, I would say starting May, I didn't know what I was looking for. It was like I would read a company, I would try to see if that makes sense, like what they're saying makes sense, and then just, invest in it, right? Um, I think that's not the way that I want to do it now. Because I think the important thing that I've learned is, see, writing a DCF is not the hard part. Writing a reverse DCF is not the hard part. The hard part is to have the kind of company that DCF can be applied to, the kind of company which lends itself to financial modeling. All companies don't lend themselves to financial modeling, especially places where you have a lot of competition, where you have a lot of unpredictability, a lot of demand supply flux, where supply might keep coming in, demand might keep going away. Those are not the places that you should be applying DCF to. That is the thing that I learned, right? So I think what my evolution has been is, earlier I would probably buy, something like a Mastech because I thought it's a good company, right? And the valuation was also cheap actually. When I bought it, it was like I think 18 times or I think 15 times earnings, right? And I thought that they had a reasonable goal, which is to, double revenues every 3 to 4 years. They had a reasonable team. They had a good stronghold in Oracle in UK, right? But eventually, what I realized is that, if I think deeply enough about it, there is nothing about Mastech that makes them unique. Not a single thing, right? To me, that is a clear indication that like this is not the company that I should be owning actually. That's what I sort of realized over time, right? So I think the big change over time has been a better appreciation for industry structure and value distribution in an industry, right? Let me give a little more elaboration to my earlier point on Saregama. If you look at that industry and look at the gross margins of each of the players, what you will find, gross margins, operating margins, what you will find is these labels make something like 50%, 60% operating margins, right? They are like a extremely profitable venture, right? And the interesting thing is these songs that the labels own are not going anywhere. People have emotional attachment to the song. They will listen to the same song thousands of times in their life, right? And probably their children will also listen to the same songs if they are sort of listening to it together, right? Now the thing is this thing actually is not something you will find in a lot of other industries. If you look at even the clients of Saregama, like Spotify, right, like YouTube, these companies are not as profitable. The reason is that the all the value is actually captured by Saregama. And the reason for that is they are the ones who have that upper hand or that um, In that particular discussion, Saregama would say that, look, here is my catalog. My songs are unique, right? If you don't want my song, go away. I will give it to four other people, and the end user will treat your app as a commodity and migrate to a different app just to listen to my song because they have an emotional connect with my song, right? That is how the entire thing goes, right? So I mean, in the interim, they might have some disagreement over, should it be priced at X or Y, right? And the deals might fall through if you look at how tips things are happening. But the larger the corpus is, for example, Saregama has 1,40,000 songs. The larger the corpus is, the much higher the bargaining power is, right? For example, Saregama with all these, old songs, Lata Mangeshkar and all the old, I think it was R.D. Burman, like some of these old singer songs, you just don't have a replacement for it, right? I mean, nobody can afford not to be in business with Saregama. And similarly, even at a global level, Warner Music Group, Universal Music Group, they have like this oligopoly over, all of music content, right? That shows the pricing power that they have and uh, the lack of buying power or the buyer power which Spotify and other of these music streaming apps have, right? Now, because of that, the margins are much higher for them. If you look at artists are always crying that, they are not paying us enough, right? So clearly, who is capturing the value? It's actually Saregama and the labels who are capturing the value, right? So I think appreciation for these things has definitely gone up a lot. um, I do want to point out one thing that, just because I appreciate these things, it wouldn't mean that I would always stay invested in these companies. Valuation is an important thing. If you look at my sheet, valuation is one of the important columns, right? And another one is sales growth. If I think that sales growth is suffering, then you will have a situation like Castrol, where like it has a very good industry structure, very good margins, but no sales growth means that you don't get a valuation, right? So that's on the first question of evolution, right? Appreciation for industry structure, value distribution in the industry. And I mean, in general, analyzing things from a Porter Five Forces kind of perspective, which is like, how confident am I that this company will actually be able to deliver on what they are promising? Right? I think that's basically our job as an investor. You might find, 500 companies which say that we will grow 20%. Are all 500 actually going to deliver on it? You might actually realize that for many of them, they themselves don't have the visibility. For example, what I learned from talking to IT industry experts is that beyond a couple of quarters, they don't have visibility. And those deals can get called off, right? If things get bad. I mean, right now they're not that bad, but things can get worse and the deals can get called off. So that predictability element is far, far lower, basically. So let's come to the second question, like who are the investors whose thought process has, influenced me and like, so I think the very first thing to point out here is definitely the forum Value Picker and all the senior members who write on Value Picker have been a very, 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 very big influence for me. There's so much I have learned from them. There's so much I learn even today, and I consider all of them to be my gurus. I actually, started learning from them. Like I basically just read the forum for 1 year. I didn't even write something because I was like, man, this is such high quality content. What can I contribute, which they have not already said, right? So for 1 year, I was simply a reader. I didn't have an account. After a year, I felt okay. Maybe I understand some things now, and I can probably start writing some things. So I mean, Ayush Mittal sir, Donald Francis sir, Anant, uh, Ankit, Dhwanil, a lot of these people have made Sandeep sir, a lot of them have made tremendous contributions on Value Picker. And not just today, but over a decade, right? So you can actually see their evolution. Hitesh sir, Abhijit Basumalik sir. You can see their contributions, their evolution over the years, and that actually tremendously shortens your own journey, right? Because I don't have to go through the same things which they have gone through. I'm able to learn from their expectations, their emotions, what they experienced at that time, right? So I mean, those are the ones which are like closest to home. Beyond that, I would say definitely there are a few funds that I really, really, respect a lot. I mean, one of them is Arvind Kothari sir from Niveshai. I think he has a small case and maybe has advisory services also. I'm not sure. But Arvind sir again is such a tremendously hardworking person. I met him, I think, for the first time in some kind of an investor summit in Goa. And Arvind sir, I realized, is probably the hardest working person I have seen. He says that I am literally going factory to factory for like 20, 30 days. 20, 30 days is continuously going from one factory to another. doing that on the ground scuttlebutt that tells him how industries are evolving and what are the latest trends in a multitude of different industries, right? Building that entire network of entrepreneurs, where at any point he might have 50 different entrepreneurs that he can reach out to in order to scuttlebutt different set of industries, right? Extremely, extremely hardworking person. So many companies that he identified so early in the life of the company. For example, the one that I'm most familiar with, Shivalik Biometals, because I own it too, HLE Glasscoat. These are some of the companies he identified. And in fact, I think like that is one of the ways that I try to filter for investors. I try to look for companies where I am able to associate with, the if it makes sense to me and they identified it, that is when I try to sort of go deeper and sort of look into what they are doing, right? And I mean, I identify with it doesn't mean ki, it has to be something I will invest in, right? It's just that I have to understand the thesis, basically. So Arvind Kothari sir as well. And then of course in the set of larger, the much larger investors, Ashish Kacholia sir is like a legend basically, right? Because he basically started out with a 9 to 5 job, and I mean everyone is aware of his success today. So I mean obviously Ashish sir and every company he invests in is something I will make it a point to read as much as I can.
Great, Sahil. Great. So, Krishna, we had a wonderful
Hello.
session with Sahil last year. In continuation, if you have some questions or maybe any new questions, so you are more than welcome, please.
Hello.
Sahil, can you hear me?
Yeah, yeah. Hi
Cool.
Krishna.
It's always great to talk to you. Always great to see you. Interesting that you mentioned, RACL, and you picked it up when it was, roughly around five times trailing earnings. So I wanted to understand more. What was the kind of information that was available, then and there? Obviously, the story that exists today was not available at that point. So how, you allocated to it? What were the things that were visible right in the beginning, and how did that story evolve? Moving forward.
Right. Actually, I mean, now we have asked two questions on which I've written threads. So I'm very happy you're asking these questions because I've already answered them. That makes it much easier for me because, it's like I just have to, sort of recap my answer. But basically, for RSCL specifically, right, the thing is, even at that point, they were not doing any con calls. They didn't have any investor presentations. But what was there was the value picker thread. The value picker thread had such a tremendous amount of information in it. And the reason is all these hardworking investors which I talked about, like Ankit sir, Ayush sir, they keep traveling to these AGMs. They keep finding out information and then sharing it freely for all of us to read on value picker, right? That's such an amazing thing. Because at that point, I mean, even today, like I don't have the bandwidth to go to like so many AGMs, right? Because I have a day job. I can't go to like random AGMs or like where I'm not very confident or like where I'm not already invested or already very interested, right? But they are going to all these AGMs, right? Because they are full-time investors. They are extremely seasoned senior investors, right? So I mean, specifically for RSCL, we knew that they had already done a lot of scale up for very marquee clients. And one thing that you have to understand is in auto ancillaries, client relationship is the moat because basically auto ancillaries and auto OEMs are very, very skeptical or very apprehensive of switching to a new supplier. And the reason for that is that basically it's you can think of it this way: making a car is a very complex thing. It has thousands of parts, if not more. Right? You really don't want to disturb this machine, this complex machine which is making that car, unless there's a very, very big reason to. Right? So I mean, when we see the kind of relationships they had with Kubota, KTM, these are some of the largest brands, yeah, especially in bikes, right? They were the first gear manufacturer to export gears to a Japanese OEM. They started with one gear. And I think at that point, when I invested, they were doing like 100 gears or a very large number of gears. And those are the kind of intangibles you could already see at that 5 PE and 70 crore market cap, right? These intangibles. Now let's look at the tangibles. This is in 2020. In 2020, if you see their 3 year CAGR, it was 17%. That was unheard of. If you looked at all the OEMs, they were basically flat. They were worse, probably. I mean, OEMs and ancillaries both, right? They were not growing. Or RACL was standing out in their industry. Then, if you looked at the operating margin, RACL had a 20% operating margin. Again, it's an anomaly because if you look at it, most of the auto ancillaries have like a 10 to 12% margin, right? Gross margin. Generally, they have like 30, 40, 50% gross margin. I think RACLs was like 60, 65% gross margin. See, the thing is, at the end of the day, what are investors doing? They need numbers and then they need narratives to understand those numbers, right? And at that point, both the numbers and the narratives were available basically for us to understand.
Yeah, I think
Yeah,
that was
I think that
really,
was
that was really helpful, especially from a process perspective, to try and understand. I've actually read the thread, but I think, getting these sort of key pointers around, one, that the information existed, so it was more like collaborative work, and you were able to use the industry structure to be able to identify, that this is something that is showing numbers that don't exist elsewhere, and that is a very useful mental model as far as like investing goes. Another question that I had was that, right now you seem to be researching Gujarat Fluoro. That's also in the Excel sheet you shared. As far as my understanding goes, this is your first chemical company, right? So I wanted to understand how you're going about building expertise or building a circle of competence in a segment where you may not have previously had any special understanding.
So actually, I want to add like two thoughts there. One is I was invested in API companies like Newland and even these diversified ones like Loris. So it's not that I haven't done work on chemical companies. API companies are chemical companies at the end of the day. If you look at Newland, for example, if you look at the value picker thread, I have actually analyzed 70, 80 of their molecules one by one, each of the molecules. Right? I've done a lot of deep work in Newland. Right? So actually, that premise is not the case that I've this is the first time I've looked at it before. That was one point. The second point was actually generally what keeps me away from these companies is how do we predict the demand supply scenario, right? We need very strong causal factors that allow us to predict the demand supply scenario. And I think where I went wrong both in Newland and in Lawrence was this ability to predict the demand supply scenario, right? Basically, in most of the generic molecules, there will be this oversupply element, and you won't even figure out where it came from. And the margins will collapse, right? And then your stock will correct 70%. And you're toast, right? That's what happens. That's the thing I was struggling with mostly. I think in Gujarat Fluoro, maybe for the first time, but it feels like this thing is easier to predict, right? Actually, if you, I would urge everyone to look at the VP thread. And like Gujarat is one of those companies which is like quite complex also, but in some ways simpler. And lot of work has been done again by VP already, right? Even before I started looking at it. The point is, my threshold for me to look at a company is high now in these sectors because I understand that they're hard to predict. And because of that, I would actually try to leverage some work that if some work already exists and that convinces me of the ROI, it looks highly probable that a high ROI can be made both for the time I invest and for the money I eventually might invest. Then I will, work on it. So that's how Gujarat Fluoro I started working. If you look at the VP thread, right, what you'll figure out is there are these structural changes where these HFCs or refrigerant gases. So the gases which allow you to cool things, both in your air conditioner and in your refrigerator, are known as refrigerant gases or ref gases. These have had different classes over the years or like generations or versions, right? Class 1, class 2, class 3, and finally class 4. Currently, we are in a mass scale, we are in class 3 refrigerants. Class 2 have mostly been deprecated or like they have gone away. Class 4 have been invented. They are called HFOs, right? But they are sort of more expensive and not as efficacious as class 3, right? But the interesting thing which is happening is 180 countries in the world have signed an agreement called the Kigali Amendment to the Kyoto Protocol, which is going to ensure that all 180 countries cut their production and their uh, production and consumption of these refrigerant gases, which are called HFCs, hydrofluorocarbons, right? These R32, 125, 134A, the ones that I was talking about. Their production is going to be cut, right? Now, the interesting thing is these cuts are not uniform across the world. These cuts are much more stringent or strict in the developed world like Europe and US. The logic is they have a higher ability to pay for the expensive new generation HFO, which is an inferior product, more expensive product, but they can pay for it, right? They will just sort of maybe fill gas more frequently and stuff, right? They will adjust, they will do more R&D, right? Whereas if you come to China and India, they don't have such stringent cuts on production and consumption. That actually ends up becoming an advantage for India. Even China, I mean, China is like the middle group. It has stricter cuts than in like stricter cuts than India, but not as strict as Europe and US, right? So actually, this ends up becoming a place where there are structural reasons. I can reason about it. Why Indian ref gas players will do well, right? That was one point. That was the starting point in refrigerant gases. Then you come to this other thing called fluoropolymers. Now, fluoropolymers, you will figure out there are different molecules like PTFE, PVDF, FKM, PFA, and you will figure out for each of them, there is their own demand and supply scenario, right? Now, I think one thing where I've gone slightly deeper this time than how I had done it earlier for Newland is that I've not just looked at the molecule and like, how many competitors there are. I've actually analyzed what the competitors are saying also, right? That's why if you remember my earlier statement that, reading one company will take months actually. Because just think about it. There's one molecule called PVDF, right? PVDF is like the hot new thing. The reason is PVDF will go as a binder into the EV battery and it will also go as a back film for solar. So it has two applications in new age tech in solar and EV both. This one thing called PVDF in two different forms, in films and binders, right? Now this becomes a very interesting thing. And that was one of the reasons I looked at it. And then when you look at similar companies in China and how much they have scaled up. Now Gujarat Fluoro will make LiPF6 also. If you look at companies in China and how much LiPF6 they are selling, how much are their sales? They have sales of 40,000 crore, right? Where is GFL? GFL is nowhere. So I mean, GFL is much smaller compared to the size of the opportunity. So I had this unique combination of a large size of opportunity, a sunrise industry, a good industry structure. For example, right now in India, GFL is the only one who makes fluoropolymers, right? SRF has been, trying to make it for 3 years. They will probably succeed next year, but they will still be in the commoditized grades of PTFE. PTFE is like the largest fluoropolymer molecule. So I mean, basically all of these things together, right?
Right, Sahil. And for those like who joined late, as Sahil has initially pointed out, any discussion on any names is purely for educational purposes only. So Santosh has been waiting quite a while. So Santosh, you can unmute and ask your question.
Am I audible now?
Yeah, Santosh.
Yeah, okay. Thank you for the opportunity. Just want to highlight, Sahil, your dedication and towards research and investment has been, very inspiring, at least for me, to go about it. Having said that, I have two fundamental interlinked questions. One is you like to pick micro caps. So how do you analyze the quality of the management? The micro cap company because they don't come up with investor presentations, very, very limited information publicly available. Second question is time management, being a working professional, having a family, social life. I mean, how do you allocate time and how do you give dedicated time towards research, all the YouTube videos, very lengthy videos that you watch on a regular basis? So, research on microcap, quality of management, and the time allocation. That is the broadly that I'm looking forward to learn from you.
Yes, thank you, Santosh sir, and thank you for the appreciation. Let's go into them one by one. So I think one thing I want to sort of make very clear on investing actually, and actually this ties to one of the earlier questions which Prince Bhai was asking, which I want to answer in a slightly different way again. How deep do we need to go to invest? Now, there is one very beautiful thing which we have to appreciate about equity investing. Equity investing is a inherently convex kind of instrument. What that means is it has a propensity to compound. Even if you make mistakes, you will compound, right? You don't have to be right all the time, right? The best of investors are right 5 out of 10 times, right? The best of investors don't have a more than 50% strike rate over the years. What matters is how much did you allocate when you were right, right? And the second and probably the most important thing, that you stay in the market. Because if you don't stay in the market, then you can't benefit from it, right? So I think the very first thing, how much do you have to study? There is no end to it, right? You can study as much as you want to. There are people who might study a little bit, they will diversify to 50 positions, they will do well. There are people who will go very, very deep. I know of investors who have 4 companies in their portfolio. they will also do well. Their ride might be much more volatile, right? I have found my perfect sweet spot at like 14, 15 companies where I don't think I'm too diversified. I don't think I'm too concentrated. The reason I'm pointing this one out is I know I will go wrong on all factors, right? That actually is not that important because I want people to appreciate when we are investing in equity, the individual companies and individual outcomes are not that important. We will not be right all the time, right? Sometimes you will be right, sometimes you will be wrong. That is just the game, right? What is most important is that we track at a portfolio level how we are performing, right? If I have selected companies with a certain characteristic and I've selected 15 of them and I have done a decent job, I'm not saying it's a great job, it's a decent job, I will probably be right 4 out of 10 times, right? Now, as long as I can keep monitoring my thesis and see whether I am right or wrong, if I am wrong, accept humbly that I am wrong and exit, right? Rather than being sort of more arrogant about it that no, I know everything, this is right only, right? That's not how it works. One can't act that way, right? Because market doesn't care about what we say or what we think. Market will act the way it does based on facts, right? If you look at some of the companies, what will happen is the facts will follow later, the price will happen first, right? So then first of all, we have to understand what was our thesis, right? We have to keep trying to update our thesis all the time. Like I will take one concrete example with you. Take the example of Mirza. The price corrected, I think 30-40% from I think 370 to like 220 even before the results came, right? Results hadn't come yet, price had corrected. Now what can an investor do, right? At some point half of the investors will get spooked, they will sell and they will go away, right? What did I do? What was my response? My response was I tried talking to as many people as possible. I went to Mirza stores. I did everything I could do. For these, consumer facing brands, you can do some digital scuttlebutt also. Like what are people saying online? What are people saying on Google Maps? There's this thing called Google Trends where you can see how much people are searching for different brands, right? I did that. I did everything I could do. And my research told me that, things are not bad. They might not be great, right? I can't predict based on these factors. I can't predict whether it will be 25% growth or 17% growth. That level of accuracy I cannot have, right? But I can get directional sense. Is it okay or is it really, really bad, right? That sense I can get for sure. That is what we have to try and get as much as we can, right? I think the important thing is we um, understand that we will make mistakes and then iterate on it. So if I take a case of RACL, we didn't know how the management was, but we had elements to understand how they have behaved. They have taken a company that was going bankrupt and turned it around and made it the most profitable company in the micro cap space, right? Then we know what they have said in AGMs. We can listen to their words in the previous AGMs and how they have behaved, what they have said. So, I mean, I want us to appreciate one thing. Even if I talk to my own parents, I really don't know what's going on in their head. They will say something to me, but how do I know that is the truth, right? Forget about a promoter who I've never met. I can't even say for my parents what's going on in their head. We can only form some mental model and iterate on it. That's all that we can do, right? So I think the most important thing is we understand what we want, what we are comfortable with. Again, if we take the case of Mirza, people will point out ये चोर है इसने चोरी की है he has tried to shortchange the minority shareholders, and that is a very very valid criticism. My only point was at the point at which I bought, which was around one time sales, maybe a little bit less, all of that negativity was priced in, and incremental direction was that he was actually walking the talk on making it better. For example, they used to take these guarantee commissions, right? And they have been reducing these guarantee commissions over the years. That is the walking the talk. You have to have a thesis and then you have to see how it plays out, right? And then it helps if you have done some study of the past. For example, if you read the Relaxo thread of Value Picker, you will find that Relaxo ke andar investors had the exact same concern of related party transaction. It's not something different. So just imagine in the same sector of footwear, two companies, concerns on related party transaction. Now, has Relaxo been a enormous wealth creator? It has been. This chappal has been an enormous instrument of wealth creation, as our esteemed fund managers tell us, right? And they're right about it. It has been a tremendous wealth creation, right? And the point is, from there you will learn patterns from the history. And अच्छा वहां पे भी तो चला था तो अभी भी हो सकता है, that kind of thing. And then most importantly, I think we have to try to control for risk. Our allocation has to be proportional to the amount of risk we perceive in the company, right? For a company like Mirza, I probably cannot allocate a large amount at cost. If I have a higher conviction in the management, I can allocate more. But I want to point out most important thing in what you said. You had a very interesting statement, which is in a small cap or micro cap, how can we trust? But if you look at it, most of the frauds happen in large caps. How did we trust Satyam? How did we trust DHFL? How did we trust Yes Bank? All of them were also trusted, right, for by all the investors. And I mean, I don't want to name other companies. I'm sure other things will also come out in the future, right? We are trusting those companies today. My point is like frauds will happen at all market caps. In fact, if anything, the smaller companies will be more willing to talk to you because they don't have this air of being a big guy around themselves. Can you imagine a promoter of a 1 lakh crore, 10 lakh crore market cap company coming and talking to you? I think that the probability is much lesser. तो उनको आप कैसे करोगे scuttlebutt? You won't be able to do it. With a smaller company, let's say you take 10 companies, you email them, कि I am a shareholder, I want to talk to you, I want to understand. Out of 10, I think one or two will definitely reply to you, if not more. My experience has been it's more like three or four. Three or four will reply to you, you can talk to them actually. So I think your
So I think
second
the
question
second.
was on, yeah, your second question was on time management, right? Like how does
Yes.
yeah, so
Yes.
yeah, thanks for the time management question again. Like I did this really interesting video with Ish Mohit, our dear friend Ish Mohit, and actually it's on YouTube also. But I'll just quickly summarize it. Like I think the important thing to understand for time management is again you have to know what your goals are here. What do you want to accomplish? I know my goal. I know that if I put this much effort and I am able to compound my capital at this level, right? I will be able to attain my financial freedom in X years, right? That is what I'm going after. Once that is clear to you, once you have that conviction, then I think putting in time is not the hard part. The hard part is prioritization. Like, how do you prioritize? And what you will find here is that most people who are very successful say no to many things. This is again, I'm borrowing this quote from Professor Bakshi. He might have borrowed it from somewhere. But basically, most people who are successful say no to most things. They don't say yes to most things, right? You have to figure out what do you say yes to. The idea is brutally prioritize. What do you need? What do you not need? I would probably not watch Netflix every day. I might watch Netflix once in 2 or 3 days, but I'll definitely not watch it every day. That is the thing I have decided for myself, right? And then we have to find that equilibrium for ourselves. How do we balance between family and investing and job? Like, if I take my example, I generally wake up at 7 a.m. Now, I generally start working at 9 a.m., right? 9 a.m. or 10 a.m. So I easily have a 2 to 3 hour window in the morning, right? And mostly I work from home. So I don't have to worry about commute. If I had to commute, I would probably listen to con calls in the cab, right? But my point is, you can always find a way to parallelize. You can always find a way to go through information. I think it's more like a mental block. You are sort of used to thinking that your life is about working 8 hours, right? If you think that, that is how you will behave. But I mean, I'll tell you where my motivation comes from. Munish Pabrai sir has this beautiful talk. He talks about his daughter called Monsoon. I think he has named her Monsoon Pabrai, if I remember correctly. So what he told Monsoon is, if you want to be an entrepreneur, do it in parallel with your job. Don't do it instead of your job. Otherwise, you don't have a downside protection. But if you have a job, give everything to your job, then work on Saturdays and Sundays and maybe like 1 or 2 hours on the weekdays, right? That way you don't have a downside. Downside is protected because you have a job.
Brilliant point.
Thank you.
Thank you, Santosh, for your very good questions. So, Malar, over to you. You have another set of questions. Yeah, go ahead. Malar, you are still on mute. You have to unmute. So, Sahil, like you talked about risk. So how you balance the risk and reward in your investment decisions?
I think like first of all, we have to discuss like how do we perceive risk, right? What is risk? Like either we can think of risk as this intangible thing that it's always there, right? Everything has risk in it. If you are driving a car, you are taking risk, right? Or you can think of it in some tangible terms. Like how do you think of risk? In my case, the way I think of risk is that basically there are few different risks that we are taking, right? One is like a terminal value risk. That is it possible that my company just won't be around? And through our investment process, we can try to eliminate that risk. If you look at Vijay Kedia, sir, and he's like one other investor that I really, really, look up to a lot. Vijay Kedia, sir, says, I will be in a sunrise industry at any cost, and I will avoid a sunset industry at any cost. I cannot tell you the number of times people have come to me with a sunset industry saying that, this company is very cheap, this has all the characteristics. But that's the thing, right? That has a terminal value risk. I don't want to take that risk. So some of the risks you can simply reject, right? That's okay because there are 5,000 companies. Even if I reject companies based on terminal value risk or sunset versus sunrise industry risk, that will not narrow down the universe too much. That might make it like, let's say, half, right? That won't, you'll still have 2,500 companies to look into, right? So some of the risks you can simply say, "Ki, yaar, I am not interested in those risks." Then there are other types of risks. Another risk is valuation risk, right? Like I am buying a company at 70 PE, right? What will happen if the company cannot execute, right? Uh, as our dear friend Ish Mohit also says that there are very few cases where the company at 70 PE is able to execute and sustain its PE, right? That generally doesn't happen. You can find a few over the years, like Asian Paints, who has done it over a very long period of time. But most companies are unable to do this, right? Even Divi's was not able to do it. It went from like 50 to I think now 30 or 35, right? Most companies come down from that 70 or whatever high PE. Valuation risk is a very real risk. How do we guard against it? Two or three different ways, right? Number one, if these factors are not in your favor, you might decide not to size your position very high, right? So basically, one way to control for risks is through position sizing. If you think that there's a valuation risk, make your position size even smaller than what you wanted to, right? There's this amazing company, let's say Sona Comstar, right? Amazing company, they are making magnetless motors, doing everything right, right? But I mean, at 200 times earnings, I am taking on an inordinate amount of risk. कुछ ना कुछ तो गलत होगा ही होगा at 200 times earnings, right? Doesn't matter like who you are or what you're doing. So even if I had to buy Sona, I would buy like 1% of it, right? Or maybe 2% of it, not more than that. That exact same company, if it were at 30 times earnings, I would obviously size it differently and size it much larger, right? Valuation risk is like another risk that one has to think about. I think a third risk one has to think about, which is I think not that well appreciated, is like volatility in earnings, right? Or like the variance of your earnings growth estimate. Let's say for a company, we have estimated that the earnings will grow 25%, right? Now think of it this way. Each and every company, your estimate of its growth is not the same. Even if there are 10 companies, you have estimated that all 10 will grow 25% in the next 3 years. Your estimate of that variance कि कितना बड़ा एक bracket है जिसके अंदर earnings growth आ सकता है will not be the same. For some, you will say, यार, I think it will be 20 to 30 with an average of 25, right? For some, you will say that. For others, you will say, you know what, I really don't know. It could be 0, it could be 50, it could be 25. वहाँ पे variance is much higher. I think if the variance is high, that is a huge risk because basically if the market is pricing in a high earnings growth and there is a low earnings growth, then you basically fall by your face and basically get hurt. If you look at, let's say, someone like Loris, they built all these expectations for investors कि हम 1 billion का sales करेंगे, right? And I mean, Chawla sir is one of the best entrepreneurs you can find in this space. But that's the thing. As soon as you have given that guidance of 1 billion, investors have started discounting it, right? And then there is like, unless your guidance is very, very conservative. In I think in Lawrence's case, it was not very conservative. They were guiding for like 50% or like a large growth over the previous year numbers, right? A very aggressive guidance has already set the expectations very high, right? And now, if there is a downside risk, then you are like looking at a loss or looking at some problems in the short term. So I think you have to understand the risks, make a list of them, different types of risks. As you have more maturity, you will be able to identify different types of risks. Promoter risk is another major risk which people call out. If you look at, for example, Garware High Tech Films. And I mean, with all respect, I want to point out this is one company which shows you that you cannot just follow a large investor like, just because X has invested, I will also invest, right? That's not how it works, actually. This is one company that like it has grown its earnings. It is doing most things right on the business side. But because of the promoter risks, it has actually derated. It was cheap at like 10, 12 times earnings. Now it has derated to 7 times earnings, right? So that was the promoter risk you were taking on. And you have to be cognizant of that risk. And then for some of them, you will say, I don't want the risk. I am just not doing it. For others, you will say, there is a risk. So let me handle it with position sizing by having a smaller position.
Right, right, Sahil. So Malhar, you there, or shall I ask the question you sent me?
Yeah.
Yeah, go ahead, please.
Hello. Yeah.
Yeah, Malhar,
So,
you had some question on the portfolio churn, so you can go ahead with that.
yeah. Sahil, what do you think about the trade-off between high churn versus chasing the best opportunities, or especially on a small portfolio size, optimizing CAGR and XIRR versus going for low churn?
Yeah, thanks, Malhar. That's I think one of the like questions which I can say is like a pet peeve for me. In fact, I had asked the same question to Ayush sir also. I think on a similar forum. I think it was Prince's Spaces only. So I mean, for sure, it's something I think very much about, right? Because see, here's the thing we have to understand. There are two ways to approach this. Number one is looking at historical examples. If you look at the number of companies that Warren Buffett owned in 1950s, and this is another thing which I think Ishmohit has said in many of his videos and maybe otherwise on Twitter, that he has owned like 400, 500 companies in 1950s, right? Just look at the churn. Like what kind of churn is that? I think at a time he might own 20, 30 companies. So that's a very, very high churn if he has overall owned 400, 500 companies, right? Churn is something which all successful investors, as far as my understanding go, have done at some point in their life. Of course, that's not a blanket statement. You can always find some exceptions, but I'm saying, there are many examples that people have done this in the like when their portfolios were small, right? That's one point. Now I'll tell you the second way to think. One is historical examples. The second way is first principles. My first principles thinking is the following: there are 5,000 listed companies. Through all my hard work, I have maybe studied 200 companies in depth, right? I don't think I've studied more than 200 companies in depth. That's like an upper bound. That means there are still like such a large number, I mean, maybe about 95% or a little more, that I have never studied, right? I would have to be very, very arrogant to say that from the 5% I have studied, I have already selected 20. And now I will stick to them for 3 years because of the ordering of my studying. Because I studied them first, so I must commit to them. Right? I think that makes no sense. There is definitely this, sampling bias. I mean, someone mentioned this concept of stream of ideas and how we study them. There will always be some bias in it. I cannot just study each and every company. There'll be some randomness in it also, right? How do I study companies? Some companies which are really good, I didn't study. For example, look at IEX, right? I didn't study. In fact, Shubham, who goes by Logical Investor, made a beautiful video on it. I watched the video and I still didn't study it, right? So that was a big mistake or an error of omission from my side, right? Where I didn't study it. My point is there are so many companies like that which I haven't studied. The point is, as I incrementally keep studying new companies, eventually there will be churn. There is no way to avoid it. Because every time I study a new company, I have a new perspective. And I end up feeling that this might be objectively better to own than the other company that I own, right? So I personally think that churn is like unavoidable, at least in the way that I think about things, which is that I mean I want to maximize for XIRR, but more than that, I want to make my portfolio as aligned with my personal investing philosophy as possible. Right? What that means is I want to own the companies which are having the highest competitive advantages in the sense of being unique, in the sense of capturing the highest amount of value in their industry, where they have bargaining power both with their customers and with their suppliers, and where the threat of substitution is less, where the growth rates are high and the valuation is less, right? I mean, that's like my wish list, right? Think of it like my wish list. I'll never get a company from that wish list. Everything will have problems in it. But I will eventually find companies which are better placed than the previous companies. One big reason for it is because I'm still very young. Maybe 20 years later, I can tell you that I have studied 5,000 companies. Here are the 50, and I'm going to own them for the next 20 years, right? I can say that after 20 years. Today, I can't say that. I've maybe studied 200, right? The second thing is reality keeps changing. Reality is very dynamic. Industries change, structures change, new things come in, new entrants come in. Because of that, I also have to reevaluate companies, right? So, I mean, I personally think that churn is unavoidable and that we should not try to avoid churn. What we should try to do, in my opinion, is that if we are making a large allocation or a large bet, then I have to be more convinced that I won't churn this position. So generally for me, the churn happens in the smaller positions, not in the larger positions. Like for example, I think the top seven right now, I mean, they have been that way for like a year, I think. And most of the churn would have happened in the bottom eight or so. And I think like basically what I'm trying to predict is also like not just the growth, but am I likely to own this 1 year later? Is this highly aligned with my investment philosophy or strategy, or is it only mildly aligned and so I might be willing to churn it? If I'm willing to churn it, I don't think I should allocate a very large amount to it.
Malar, any follow up from your end, or shall we move on to next question?
Yeah, I think just one quick question, slightly on a different side on circle of competence. So you mentioned some companies that are very difficult to study or complex. They have many moving parts, and it takes quite some time to understand it fully. So I am curious to know how you think about return on time invested in terms of researching these companies, and at what point do you sort of put it in the too hard pile versus at what point do you say ki let me still try and understand it better and try and figure it out. So uh, for complex businesses, do you and at what point basically you uh, think that I should go ahead and still try and figure it out versus give it a pass?
Yeah, I mean, I'll be honest with you. Like I think, I mean, I don't remember who said it, but someone said that the best business to earn is the one which is simplest to understand and explain, right? Like maybe Warren Buffett said it. I'm just going to attribute it to him. Like since most quotes are attributed to Warren Buffett. I mean, my point is, see, if it's a simple business to understand, that will of course be far more attractive to me as an investor because I don't have to break my head on understanding it at least, right? I think one of the simplest businesses I know about is Red Tape, right? They are basically a brand. They are basically like a HUL that, I have built a brand. I will outsource manufacturing. I will do the designing. I will manage the logistics. I will manage the like the inventory and stuff. But I mean, everything else, I will just outsource it, especially the manufacturing part of it, because they've figured out that, mostly, I mean, these things are more commoditized. I mean, at least the way that they look at it, right? That's what they have figured out. Now, red tape is one thing where I feel that it's much easier to understand, and I also know the important moving parts. If I study the history, I know that like in retail and especially these kind of retail where there is some seasonality, there is high inventory because of different sizes, different colors, different designs and stuff. One of the largest things to track is the inventory and how they handle inventory. Are they able to grow without growing the inventories proportionately or faster, right? You don't want that the company is doing 20% growth by growing inventory 30%, right? You don't want that. You want if it's growing 20%, ideally inventories should grow sublinearly. Like maybe, I mean, less than that, right? Maybe 10-15%, not much more than that. So that's one example. Now let's come to a opposite example. I'll tell you my personal thoughts. Like, I feel like companies that make generic chemical molecules, and especially companies that make a large number of these molecules, are, in my opinion, the hardest ones to track. The reason is, just imagine I mentioned Newland, right? What would be the optimal way to track Newland? It would be that I would, for the all the 70 molecules, I will keep track of all the manufacturers in the world, their capex plans, and then correlate it with the way that Newland is likely to shape up. I mean, especially their generics division, which is, I think, more than half, right? So, I mean, it really impacts their top line and bottom line. Now, again, that's not to say that the business won't do well. I mean, anyway, the management is very conservative. Their guidance is we will grow 15 to 20% CAGR over a 5 year period, right? So they are saying ki don't expect year-on-year growth from us. Expect that over a 5 year period, we will grow 15 to 20%, right? So very conservative. But as an investor, if I really want to track the business, I have to actually track 70 molecules and competitors for 70 molecules. Some of the molecules have 20, 30 competitors. You can look at it from the DMFs filed, right? They are an API company. You can look at who else has filed for that same molecule in US. Some of them have 20 competitors, right? I mean, they won't all be unique, but if you sum it up, it will easily be 50 companies. You have to track 50 companies. Or the other thing that typically people will do is take a valuation call that, this is too cheap. Most of the negativity is priced in. Eventually, there will be mean reversion. I have trust in the management, so I'm going to buy it, right? That's another way to do it. So, I mean, just to answer, like, I feel personally that, chemical companies with a large number of products are like hard to track. Um, and hard to model. Like it's hard to get this confidence on what is going to happen. And for example, I know that a lot of good investors also track these spreads for these chemical companies. The difference between the input and the output, right? That's another thing that they keep tracking. That this is the input, this is the output. How much is the spread? If the spread has narrowed, then the profits will go down. If the spreads have gone up, profits will go up. So you buy in a counter cyclical way, which means if the spreads are low, then you buy it. If the spreads are high, you try to estimate ki maybe the peak margins are around and then you sell it, right? So I mean this contrarian kind of investing. But I mean, I'm just saying that for me, I want to have a lot of predictability for the business to the extent I can have it. So I mean, these are the ones I find hardest. When do I decide? I think like there's no good way because everyone makes mistakes, right? So I mean, I thought I had done enough work on Newland, but it turns out I had not done enough work, right? So I realized when the market indicated to me that no, Sahil, you're wrong, you have not done enough work, their margins are suffering, right? That's when I realized, okay, I think I went wrong and I need to sell.
Yes, Sahil. So, Sahil, my next question would be, and for the attendees, like I'm getting some requests in the DMs that they are unable to send a speaker request. So perhaps if you are joining in from laptop or PC, in that case you might face some issue. But otherwise, if you are joining from a Twitter app on mobile, I don't see there would be any issue. Yeah. So, Sahil, like, what's your opinion on the current state of the market, and where do you see opportunities for growth? And on the top of that, like, how do you stay up to date with the latest developments and trends happening in the market?
So actually, that's a great point. I want to add a very contrarian opinion here. Like generally, what you will find a lot of investors talk about is the fact that uh, any time spent on macro is time wasted. Now, I am 90% in agreement with that statement, but 10% I will disagree, and I'll tell you why. I think macro has a very important role to play for the discount rates that you will give to your valuation, right? Which means if you are at 0% interest rate, you are going to say that any multiple is low enough, right? Shopify at 50 times sales is just a platform business, so it should trade at 50 times sales, not earnings, right? At 0% interest rate because money is free, right? Money is literally free. You can have as much money as possible. So to that extent, I think for the valuation, for the exit multiple, for the discount rates, macro plays a large role. The reason I'm pointing that out is I think I have spent a whole lot more time thinking about inflation and interest rates, at least the limited that I have read. And again, this is where things get a little murky because then people will say that, where do you draw the line? Because the thing is, if you look at how or why inflation is happening, you will start going a little bit into geopolitics. That basically if you look at most countries, they are saying we will become atmanirbhar, right? America is saying I want to become China independent or atmanirbhar, bring all the manufacturing fabs to America, create local jobs, create batteries in America, create everything in America, right? And like that every country is literally saying that, including India. So of course, all of that creates inflation, right? Inflation might perhaps be a lot more sticky. I'll tell you why that matters. That I think should allow all investors to become more conservative. It is no longer the case that a company should get a 35, 37 PE multiple. In general, that is not the case. It shouldn't happen. Rare companies will get that multiple, right? Rare companies will. But that is not a okay thing to happen like randomly. So if you look at companies like Data Pattern and MTAR, right? Those are two companies that I really, really love the company and like what they are making, their products, management, everything. But just look at the valuations, right? I mean, maybe 6 months to 12 months ago, they were at like 100 times or 120 times earnings. Today, they're at 60 times earnings. What has happened? The price has actually not fallen 50%. The earnings have grown, price has fallen a little bit, and the PE multiple has contracted, right? And that will happen. So the you might ask yourself, yeah, these companies are growing at 100% in some cases. Look at MTA's latest quarter, right? I think they had like 80 to 100% growth or something like year on year. But I mean, still the price has not gone anywhere. That is because what market is telling them is, yeah, I had already discounted your growth. So like you're growing, but that's okay. Like I already knew that you were going to grow. So like I'm not going to increase the price, right? Um,
Um,
so I
so
think
I think
yeah, yeah. Go on.
go on. Yeah, go ahead. Go ahead.
Okay, so there is a similar question on the discussion which we were just having from Maruf Alam. He's asking, let's say there is a sustainable tailwind which is going to last for a long term. For example, in the defense, software as a service QSR space, then how do you screen companies in the value chain of the whole industry? How do you know in which companies to bet in the whole value chain?
So that's again a great point. I think like there are two three different things at play here, right? One is you can go to screener, and for a particular industry you can look at all the competitors side by side, right? Screener allows you to look at companies by industry. For example, just look at defense, right? You will probably find 100 200 companies. Now what kind of companies you want is a very personal decision, right? What kind of companies I want the kind of company which has the highest value add, which has the highest growth, which has the highest ROC, right? That's what I want. I want like hopefully the best companies, right? Of course, you'll never get the best companies, but you're looking for that. So if you tell me like look at this company like Bharat Electronics, what I will tell you is they are just aggregators, they are just assemblers, they're assembling things, they're not adding that much value. Look at data pattern. Data pattern is creating systems and subsystems. That is why their margins are high. That is why their value added is high. And that is why I am more confident in investing in data patterns because I can see that under the defense, there is a second tailwind that is for make in India and design in India. India designed Indian intellectual property will win out over बाहर से import किया and उसको you put it together and repackage it and sell it. So I mean for that reason I would always prefer someone like a data pattern. How do you screen it? I think you have to look for things. For example, if companies are adding high value, they would typically have higher gross margin. So if I just look at my portfolio, with the exception of like maybe two or three companies, most companies in my portfolio will have a very high gross margin. Some of them have 70%, some of them have 60%, right? And you can just randomly look at companies and figure out most companies don't have a high gross margin. ज्यादातर कंपनीज का ग्रॉस मार्जिन विल बी 30-40%. It won't be 60-70%. Rare companies it would be 60-70%, right? So I mean those are the kind of companies I like. I think it comes down to like your personal choices, like what do you want.
Right, Sahil. So we have Ishmohit with us, so definitely we'll be having a tough question for you now, Sahil. So yeah, over to you, Ishmohit.
Yeah, I don't have any question. I'm just listening to Sahil's talk, and I'm really enjoying it as well.
Yeah,
Yeah,
thanks,
yeah.
thanks, Ishmael.
Thanks,
And
Ishmael.
I mean, one thing I want to add very, categorically, like in the beginning, I mentioned some of the investors I look up to. I think in that list, right up there is Ishmoit, right? He's one of the hardest working people. In fact, like I didn't even know that I could work that hard until I started watching SYC videos. When I watched the videos, when I saw ki kitni depth mein, the extent to which he goes, that actually motivated me and that actually inspired me. Okay, if he can do it, then I can also try and go to that depth, right? Because before that, I didn't know that it could be done. Like, especially by like someone like us who like I mean I consider like Ishmael and me to be uh, relatively more inexperienced, right? Like I think he would have like more than me, like 7-8 years, 10 years, and I would have like 3-4 years. But I mean, what I thought is maybe these people with 20-year experience can do these things, but I can't do it. But then when I looked at him, I realized, okay, even we can do it, and like experience helps, but that shouldn't stop our hard work. We can always go deeper.
And Sahil, like Saregama video was the first video when I came across Ishmohit, and rest is history. Like we have been connected on daily basis. Then, yeah, Ishmohit, you were saying something.
So I'll just one question. So I think this was about like 8-9 months ago, where we had a word on one of the ARV companies, and we thought that Paxlovid revenue is coming in and this could be one off. And in the con calls, the management categorically denied it to be one off. Even still, I think last quarter also they denied it to be one off. But we can see that Paxlovid sales and everything might fall, like what happened with Molnupiravir. So, thinking it through for like retail investors, and also one more question to this is that in ARV business as well, a lot of peers like Lupin, Aurobindo Pharma, and other like unlisted pharma companies, they announced expansion because they saw that this company is making more than 800-900 crores of cash flow. तो हम लोग आगे से compete क्यों नहीं करते? So in a B2B business, don't you think it is really difficult for retail investors to track so many minute details as compared to some businesses where it might be even simpler to do it?
Oh yeah, that's a very very wonderful question. I think. So I think you have brought up like I think two related things. Like one is on this one-off thing. Like I'll just share my personal thoughts with you. Like the thing is, I think most of us would agree that it's one-off. I think the way that the management was looking at it is key. Like there's no reason why they would stop making Paxlovid. It is possible that the demand for Paxlovid might fall off the cliff, right? That is what we as investors are calling one-off. I think what they are trying to say is key, we will keep making Paxlovid as long as Pfizer wants Paxlovid. Right? So I think it's a little bit of like a nuance, and one thing which makes it hard is key, it's a patented molecule and like they can't really talk about it. We'll just jump around it and we won't actually say Paxlovid, right? So, but I totally agree with you that like anyone who is watching it carefully, I think I especially remember you had shared the broker note also, which talked about the fact that a lot of the earnings in this quarter were because of Paxlovid, and that's a big risk because of course the demand for Paxlovid will go away as the pandemic goes away, and so the earnings can fall off a roof, right? Fall off a cliff. So I totally agree with you. And especially as a retail investor, like we have to be very unemotional about these things. I personally feel like rather than thinking ki I'm a buy and hold investor, I am going to buy and hold as long as the thesis is intact, right? So actually, I think just to add to your point, right, I have a brilliant data point there. All that one had to do is not to track these things. All one had to do is just to look at the VP thread because people were updating that thread with similar takeaways. I still remember Rupesh sir. Rupesh sir is another really experienced investor that I really look up to and follow. He updated the same thing that if you look at, I think, SMS Pharma or Bindo and some of these players, they are talking about this pricing pressure and the commentary is slightly different from Loris and that we should be careful about it, right? So, I mean, related concerns were expressed and we had to be very careful, right? The least I think that we had to do is to reduce the position because the thesis had become less strong, I would say, like not as strong as before, right? And then, of course, like slowly over time, we realize, okay, yeah, there is one off and all of that. But I agree with you that, like in general, B2B businesses are much more risky, like especially in places where there are many competitors, right? If the competitive intensity is high, it's also hard to keep track of competitive intensity. How do we even know that a unlisted player is announcing a capex, right? It's very, very hard to track. So, I mean, to that extent, I agree with you. I think the only thing I am a little bit worried about is that mostly what I've seen is B2C companies valuation is just bit to the roof, right? It's very hard to get a company at a like a reasonable valuation. Even if you look at some of the really good companies, right? Most of them would be at 50, 60 times earnings, right? Very hard to get like at even 20, 30 times earnings. And then like I think like even there you are taking on the the valuation risk that at some point they might falter, similar to Dr. Lal or any of these other B2C companies.
Right. I think totally makes sense because
because
one
one
of
of
the
the
intermediate
intermediate
players
players
which
which
was
was
manufacturing
manufacturing
these
these
ARV
ARV
intermediates,
intermediates,
they
they
announced
announced
six
six
quarters
quarters
ago
ago
that we
that
are
we are
seeing
seeing
our
our
volumes
volumes
falling
falling
off
off
the
the
cliff.
cliff.
And
And
I
I
think
think
now
now
तो
तो
उनका
उनका
पूरा
पूरा
intermediate
intermediate
business
business
ही
ही
pharma
pharma
का,
का,
they
they
are
are
basically
basically
diversifying
diversifying
away from
from
it.
it.
So
So
that
that
is
is
also
also
like
like
idea
idea
of
of
tracking
tracking
value
value
chain.
chain.
But
But
totally
totally
agreed,
agreed,
yeah.
yeah.
मतलब
It's
there
there.
it's
It's
basically
basically
difficult
difficult
in
in
B2B businesses to have a track of all the key variables.
Right,
right.
right,
Yeah,
right.
absolutely.
Yeah,
I mean,
absolutely. I mean,
yeah, Prince, you were
yeah,
saying something.
Prince, you were saying something.
Am I audible, Sai?
Yeah, yeah.
Yeah.
Yeah, yeah.
So the next question is from Pankaj. So he's asking, do you see any moat in Sarthak? Hello.
Uh, yeah,
Uh,
I
yeah,
could hear
I
you a
could hear
little bit.
you a little bit.
Yeah,
Yeah,
I'll give an answer.
I'll
I
give an
just
answer. I
wanted to
just
request if
wanted
you
to
can
request
mute
if
it
you
because
can mute
otherwise
it
there's a
because otherwise there's a feedback. Yeah, thank you so much. So I think the question was, is there a moat in Sarthak, right? So I think one thing I want to be very, very clear about. What we are talking about here are like small companies with like, some 100 crore market cap or like 50 crore, 100 crore sales, right? Actually, if you look at the history of companies, nobody in 1998 was writing about the moats of HDFC Bank. That was not a moated business, right? So actually, in a very small company, I think if you're looking for moats, it will be very difficult actually. In the case of Sarthak, though, uniquely, actually, I think there is some elements of a moat. Like you can't say in a company like that that there are any real moats. But what you have to find is, for example, like part of the thing that they exist in is very concentrated, and I think they're the industry leader in one of them. The other thing you will find is they are making all the right steps of going into higher value added segments, like these aluminum coils for electrical applications, right? So they're actually trying to even break from the cyclicality of the steel industry. And the most important thing, I think, like when the valuation is low, you are actually not taking on too many risks. And then you look for some of the more, interesting factors. For example, number one, in generally in micro caps, you don't find good cash flow. That is because, you see, the thing is, large companies can squeeze their small suppliers. They can say, ki, I am Tata Steel. If you want to give me, you want to sell product to me, you have the, like, basically, it's a privilege for you to sell product to me. So I will give you money after 100 days or 500 days, right? Sell product to me if you want to, otherwise go away, right? Now the thing is they have amazing cash flows, actually operating cash flows, right? Even operating cash flows are not that easy to get in a small business. Some of the businesses that I own, like RACL and Shivalik, even they struggle to have operating cash flows, right? So I mean, first thing I saw, operating cash flows are good. Second thing I saw, their debt was coming down, right? That meant they are not just like paper cash flows. Most likely they're paying down debt with it, right? They're actually making money. The third thing I saw, their margins have been so stable over 7 years, right? So actually, the steel cyclicality might impact them a little bit on the volume side. It will impact on the realization side for sure, but the margin side hasn't suffered that much. So to me, what it indicated is this is perhaps not the kind of company that should trade at 5 times earnings. That was my only thesis, right? That at 5 times earnings, this is just too cheap, doesn't make any sense. This doesn't have the cyclicality of most of the other companies. By the way, I do want to add that, market won't always agree with you, right? For example, if you look at mining companies also have some of these characteristics. They have a very high ROC, but mining companies also trade at a very low multiple, right? So, I mean, market won't always agree with me, which is okay. But I mean, I think in hindsight, it was like a more like a I think it was like an investment which is contrary to my own investment style, which is, it's in the commodity value chain, doesn't have very good margins. I mean, gross margins. Uh, let's see. Like it may or may not work out very well. And I want to be very clear with everyone that, just because I'm talking about a company doesn't mean that I will own it forever. Especially if I can find a better investment, I will, just switch out without batting an eyelid, basically. And at that point, my thought process was that I own this other company, which has a similar sales base. I think it was a better company, but that other company, which was making ramming mass, was at 50 times earnings, 50, right? And my this other company, which is also making a consumable, so the wired rods that they make, uh, those are also consumables in the steel process. Though that company is at 5 times earnings, this company is at 50 times earnings. To me, that felt like a very clear switch, to be honest. And the other thing is, like, I will not generally switch just for valuation. Sarthak was also doing a capex, expanding capacity by 50%. They were hoping to utilize it in, I think, 2 3 years. So, like, 17 to 25% growth. So I thought that that makes sense. But I do want to say that, like, it's very cyclical. So, it may not turn out the way I think it will. Yeah,
Sorry,
yeah,
sorry,
Prince,
there
you're
was some
audible.
glitch on Twitter. So there is one question from Rocky. He's asking how to ride winners, say after 2x or 3x. How to curb the propensity that the we normally get so as to book the profits early.
I will be honest with you. Like, I think that these, these what do you call them? Like, let's say short forms, right? Ride winners, don't catch a falling knife. Typically, they are never 100% true. The answer to most of them is it depends. Or in some contexts they make sense. In other contexts they don't make sense, right? I mean, this was beautifully explained by again Professor Bakshi in a podcast I was watching today morning only, that this concept that most successful people say no to most things, right? That's a very beautiful quote. It makes sense, right? People can't prioritize everything. But imagine if a teacher said no to all her students or most of her students कि नहीं, मैं तो सिर्फ 1% या 2% बच्चों के डाउट सॉल्व करूंगी. Of course a teacher can't say the no to most students. So I mean, we have to know the context in which to apply that quote. I think one of the things is we take quotes as being truisms कि ये तो हमेशा ही सच है. Even Warren Buffett quotes, like, we will take it as like written in a religious book to be followed forever, right? A religious saying. That's not how it is, right? It is to be questioned, it is to be critically examined and applied only in select situations where it makes sense, right? So, I mean, even in the case of what you said, ride winners, in some cases it makes sense to ride winners. In some cases, it doesn't make sense to ride winners. I think there are two, three different things which we have to keep evaluating all the time. So, just like Ishmohit mentioned, right? If you were a Loris Labs investors of 2018, 19, or 20, I think you would have made at least 5 to 10x of your initial capital, right? It turned out that it might have been good to not ride your winner beyond a point, right? And to actually like sell out, right? But how do you know? I think the answer to that is number one, tracking the business execution, right? Are there incremental risks which were not there when I first made the investment, right? Which are surfacing today, right? For example, for Loris, that red herring was clearly given by Naveen Fluorine in its con calls for ARV intermediates and some of the other ARV API companies as well. That we are seeing lower volume offtake and so forth, right? And then there was this global fund which publishes how much ARV they will buy. Even their projection was for lower buying in the next year. That was another piece of evidence. The fourth piece of evidence was this like Paxlovid thing which happened, right? Which was again very clear to anyone who had access to that brokerage report. You don't have to do the groundwork. You just have to read, right? And perhaps have the right, connects who might be willing to share the knowledge with you. So, I mean, at the end of the day, we have to track the business, right? That's the number one thing. I think the number two thing is valuations. At some point, it won't make sense to ride. Now, you will either sell before the top or you will sell after the top. I don't think there's anyone who can sell at exactly the top, right? We just have to figure out does this valuation for this business make sense or not, right? And I'll tell you this beautiful thing about markets. When the valuations are low, markets will find different kind of excuses for bidding the company up, different types of narratives. When the valuations are high, the market will find different excuses for bidding the valuation low and for crashing the price or the valuation, right? So I mean, I'll give you one more example. Like there's this company Sequent Scientific, right? Actually, I think I started studying it only after like Ishmohit said, this is a good company, please try studying it. I tried studying it. I think my buying price was much above his buying price because, of course, I started studying it much after he did. Right, but I did my independent research. I listened to the con calls. I read the con calls. I read their annual report. I read Sequent 2.0. Right, all the right things. Now the thing is, when I started buying it, it was around 30 times earnings. Right, eventually it went to I think 60, 70 times earnings. Right, at some point you had to ask yourself, is this getting too much? Right, is this getting too much? Is it truly a branded company? Right, at that point we thought that it's a branded company, right? So actually, I'll be honest, it's not that I had some unique insight that it's not a branded company, because that's how I think the previous management used to talk to investors, that this is a branded, these are branded things, right? The new management says no, they're not branded, they're more like commodity, right? But I mean, at that point investors thought that it's branded, but I think the valuation risk was very clear. What that meant is, incrementally, if there are any negatives, then the stock price will not respect your whatever you think. It will go in one direction. So that was to me a trigger. I am able to find other opportunities which are at lower valuation. I'll give you one more quick example. There's this company called Polymedicure which makes these consumables in the medical space. I think they are mostly like IV cannulas and stuff, sort of blood transfusion and all of that. These get used, right? Again, a brilliant company. The best thing about the company, if you look at their sales growth, just look at open screener and see the sales growth, quarter to quarter sales growth of Polymedical. You will think that it is probably an FMCG company because it has been growing consistently at around 15% for like 15 years. And you don't find this kind of consistency in a B2B company, right? That continuously it has been growing, right? That company, I think, because of the COVID panic, was available around 30 times earnings, right? My thought process was simple that this company has shown such tremendous consistency that I don't think that it deserves to trade at 30 times earnings, right? It had corrected a little bit from before. I bought it at 30 times earnings. Then it started going up, and I think it went to around 80, 90, or 100 times earnings. I don't remember the exact multiple, but it re-rated like anything. Now, again, you have to take the same call in the reverse direction. That, okay, this was at 30 times earnings, but at 100 times, 90 times earnings, does it make sense? Then they announced that they will do a capex, right? That means that their near-term ratios might suffer a little bit while the capex happens, while the pre-operating expenses come in and stuff, right? So I mean, I think that that's when I decided that again the valuation is like too high and I need to sell.
Right.
So I'll give you just so that sorry for the interruption, just so that you don't think that I'm always just doing the right things. Web of Global is one company where I was unable to sell on valuation. So I think I bought it around 25, 30 times earnings. Thesis was similar, looked like a good business. It went to I think 60, 70 times earnings. And like that's when I think I made that cardinal mistake of extrapolating the past. I thought ki now there's a structural change and they will grow 25% for many years. That obviously didn't happen. It turned out that COVID was just pulling that demand forward. And unka jo growth hona tha over 3 years, that happened in 1 year. And so obviously the next 2 years they suffered, right? But that's where I made a mistake. I extrapolated the past and I didn't sell on valuation. If I had sold on valuation, I would have, I think made a decent XIRR and then deployed it in a good place. But I think we just learn from our mistakes, hopefully.
Right. So question for you, like he's asking regarding focus lighting, apart from their first ever con call and recent interview of the promoter, is there any other data point that is adding to your conviction?
So I think like one thing I want to be very, very clear about, right? Um, Companies that I haven't made a thread on, it basically means I don't have that high level of conviction, right? It means yeah, I'm still researching it, right? So I mean, I'm not going to go ahead and say that this is the best company ever. I just heard about it a few months ago, right? And it's a small position for me. I don't have enough conviction to make a thread about it. Whenever I have enough conviction, then I will make a thread about it, right? Until that point, I can't. So, I mean, just to answer, I really don't have any special insights. What I can tell you is when I share information, people reach out to me. So, someone reached out to me. They said that, I am a distributor or something for Focus and I can give you some scuttlebutt, right? That's what happens. That's what I love about Twitter. So people keep saying that, why do you share on Twitter? What's the point of it? Every time I share about the company, someone reaches out to me either with positive or negative feedback about that company. And that helps refine my own process, my own understanding of that company. Right. So I mean, to be honest, I don't have any extra insights. I just know primarily what is there in that interview and what is there in that one con call and one investor presentation. Right. Those are the primary sources of our understanding of Focus. Um, but I think it's an evolving story. Like you have to keep monitoring, keep studying it, and then slowly you will build conviction, right? Because right now what you can see is that they're guiding for 30% growth. That is clear. What is not clear is whether they will be actually able to execute it or not. I really don't have an answer to it. I really need to study a lot more to be able to answer it either way.
Right. And even there is much more behind the name of the company, right? So the please take whatever being shared on Twitter or over the podcast as a starting point so as to do your deep research. So Sahil, next question is around like you already have shared a detailed thread on PIX transmission. So is there any change in view or anything? There is one question from Sandeepan around this.
Sorry, change in view on which company?
fix transmission.
So I think fix, I have actually talked about it. I think the biggest thing is fix number one. They are a recession proof company in the sense that their sales don't suffer in a down cycle, right? But unless there is good growth in the end markets, it is not that easy for them to grow, right? That's one point. The second point is until now, they were unable to make that capex work, right? That capex, I think earlier they had guided that it will commercialize in April, but it has actually taken until February, right? They just gave a notification few days ago that the new capex has commercialized, right? So I think to be honest, like my latest thoughts on Pix are that now, like with more understanding, especially after attending the AGM in person, I feel that it will not be easy for them to grow 25%, even though like they say on their website that it is our goal or our sort of we want to grow 25%, right? They say we want to double in 3 years. The thing is, this is a very sticky client base, right? They are very, very, very sticky. I would actually like I would be very happy if they can grow 15 to 20%, right? So I mean, to that extent, like I don't think that it is like something which uh, is able to compare to the other companies that I hold in terms of the growth rate.
Right. So next question is for Sahil as well as some comments if Ishmohit has. So the question is like, what should be the strategy for investors to invest those who cannot research independently and want to allocate big in individual stocks?
Like I just want to quickly go first because I think the answer, at least in my mind, is very clear. The strategy should be to not do that. Like that is a recipe for disaster. You have your life savings, and this is like playing gambling or jua with that money, right? If you are not willing to put the time and effort to research, then I think the best thing you can do is to go to a professional money manager, the one that you feel most confident with. And even if you don't trust money managers, put it in an index fund, I would say. And if you don't like the volatility of equity, then put it in a fixed deposit. I think like putting it in a few companies without research is like a recipe for disaster, in my opinion.
Hi, so am I audible, Prince?
Yeah, Ishmohit.
So I think what you can do in this scenario is ki, either be very very picky with the companies that you want to research. Malab, they should be clearly the market leaders, and there is no margin volatility in those companies, and they've already established themselves. And you need to obviously take valuation calls. And there's also an advantage for you this ways because you can ignore a lot of noise in the daily quarterly results as well. So, but you need to only select or filter those companies which exhibit all these qualities of non-volatility. Second aspect, what you can do is suppose if first thing that you is the first point you cannot basically completely fulfill. That second thing that you can simply do is to actually look at an index fund or secondly look at mutual funds. But what even in this you can do is कि you can buy sectoral Bs. जैसे bank Bs है, IT Bs है. So you can just simply go and look at the PE multiples, price to book multiples, and basically the dividend yield of the sectors. Trend line पे freely मिल जाएगा data, and just see which one is below the mean. So of one of the investors I know, हम कहते हैं यार स्टॉक वॉक तुम करो, मैं नहीं कर रहा ये बिकॉज आई डोंट हैव सो मच टाइम, नीदर आई कैन बेसिकली इतना वॉलिटिलिटी में बर्दाश्त कर सकता हूँ. सो ही सिंपली जस्ट बाइज दीज सेक्टोरल बी लाइक फंड्स. जैसे इन bank Bs he has made very good returns, so he allocated like very high amount to public sector bank Bs when they fell to at least like 10-15 year low on in terms of valuation. So uska like framework was simple कि sometime it will revert to mean. So there is this idea of beat Nifty using Nifty strategy, and you can simply just maintain a valuation of all these sectoral indexes, and then you can look at basically sectoral ETFs. So this is also one of the ways to actually beat market if you and because you have less time with you, you will actually be more patient. So this will give you actually an advantage over a lot of active investors as well if you can completely practice this. Basically, if you can completely practice this philosophy. So that was from my side.
Thanks, Ishmohit. So, Sahil, there are many stock specific questions, so we won't be taking all because, and also I would want to check on how good we are on time. Actually, we are almost 2 hours, so uh,
Yeah,
are we
I
good with
think
the
we
time?
can go for like, yeah, we can go for like 10, 15 minutes maybe and then end it.
Right, right, right. So one question is around like IIFL Finance. If you have any business view or or comments on the basis of recent con calls or the recent results. So that is question number one. And another question is on Alphabet. So do you see any risk or opportunities in Alphabet?
So I think second one is easy. I cannot talk about it. Being an employee of Alphabet, I just cannot talk about it. So sorry for that. That's the one company I'm not willing to talk about. Uh, the other one is about IIFL Finance. Like I think uh, in general, right now there are few different things which are happening. One thing is that like they have given a public guidance of they will double their AUM in like 3 years, right? And I think they are roughly around that mark, even in execution. I would say right now thesis is playing out as we thought it will. The second thing is if you look at all the gold lenders, I think they're actually gaining market share in gold lending, right? So I think it's doing all the right things, which is why I'm still owning it. I still think it's very sort of undervalued compared to other companies. I think market has some concerns on like these particular kind of industries like gold lending. Uh, Probably that's why it's cheap. And then I think they have some large losses in the MFI space also. That might be another reason. I think the home finance business is much better. I think it was Abu Dhabi or one of those investment funds also invested in the home finance subsidiary. So as and when they list it separately, I think that could be a very large value unlocking event if they do it. So yeah, that's thoughts on IFL.
So like Ishmoit also can add to this. So the cost of fund is increasing owing to the increased interest rate. So does that, I mean, obviously they have to pass on the increased rate on the lending side. So does that bring an element of, I mean, if the interest rate on which a company is lending increases, so obviously the risk associated is comparatively more. Any take on that, Ishmoit and Sahil?
So, Sahil, are you going first or should I?
No, please go, Ishmael. Please go first.
I think another thing that most of us are missing out in terms of risk when it comes to banking sector is that next year what is going to happen post this HDFC merger is complete is literally going to be a war for deposits because HDFC's size will increase a lot and this was covered in latest Kotak Daily as well. So all the banks will experience a rise in cost of funds. So at the moment in the sector, if you are invested, like bottoms up, you have to be very picky. So like how I'm actually doing it, ki I'm actually looking. So one of the lenders that I'm very interested in, and I also own. So that lender has a credit to deposit ratio of 75 to 76%, whereas for good banks, credit to deposit ratio is 94 to 96%. So it means कि आपने कितना लोन दिया और कितना आपके पास डिपॉजिट है. So how efficiently are you using your deposits? So over there, at least for the next 5 to 6 quarters, the like excess cost of funds won't hit them basically. So that is one way to look at it. Second way to look at it is in terms of bottoms up only. Is that what has happened is, see, most of these actually like 90% plus of these industries are cyclical, and banking and finance is nothing different. So second thing that one has to think about is that if you read the conference calls of Kotak Bank, so he'll give you कि कौन से sector में growth आ रही है. So currently Kotak Bank is literally growing its microfinance, acquiring companies in microfinance, and growing the SME and MSME portfolio like really fast. So that is where I think opportunities exist bottoms up today as well, because those loans are 1 to 5 lakh type ticket loans for especially the smaller lenders, 1 to 5 lakh, 1 to 10 lakh. Recently, one of the NBFCs listed, which is literally doing 7% ROA, which I thought wasn't possible in a SME type lending or a small business loan type lending, and that is one place where you can check. Right, over there जो customer है वो इतना interest rate sensitive नहीं है because already he is paying very high yield. Third one which you can check is actually ये बहुत deeply cyclical है. So like because my views will change along with data, and they can, because I have my own exit system in place, so it becomes very peaceful to like look at these cycles. So third one is microfinance actually bottoms up, because microfinance में क्या हुआ है, there are two very positive developments which have happened. Is that your price caps have been removed. So for NBFCs, what has happened? कि पहले NBFCs जो lending करती थी ना माइक्रो फाइनेंस में, so their interest rate they could charge was capped. So this actually disadvantaged them over banks and other small and other small finance banks, because आप ना risk price कर सकते हो एक district के हिसाब से. Like in one district there are much more NPAs that come, so you can price your loans higher over there. So you can price your loans according to the like type of lender that is according to the type of borrower that is coming to you. So this is first change which has happened, due to which you won't see microfinance companies NIMS like compressing. Actually, like some of them have expanded the NIMS, even though cost of borrowings will increase. But because ये price yield हट गया इस वजह से, you will see that this microfinance cycle probably is going through an up cycle. But you need to time it right. Like you won't be able to perfectly sell on time or basically perfectly get the top on time, but you need to actually just be very very careful with it, because it's cyclical sector hai. So know the basically know the evil that you're dealing with. That is a deeply cyclical sector. So this is how I'm basically viewing it bottoms up. कि अगर ऐसा होता भी है, so this is how like on a portfolio level basically you are protected. And lastly, because see what has happened, कि banks में एक liabilities होता है और एक side पे assets होता है. So what are your sources of fund? It is basically your deposits and stuff. And what is your application of fund is basically giving out loans. So historically, like last 4 or 5 years, there was a problem in application of funds, that is giving out assets because of asset quality issues, right? But now all of us are thinking now there could be a problem on the liability side. But if your asset side, right, if there is no NPA cycle for next 2-3 years, अगर निम थोड़ा सा compress भी कर जाए, even in that scenario, banks will have the confidence to keep growing their books at a very fast pace. So I think that is also fourth way to look at it. But definitely risk is there कि कुछ banks का NIMs will definitely compress. So those are just my views. Sahil, over to you.
I think your original question was on cost of funds, right? Like cost of funds is going up, and what will happen, right? So I think that's a very interesting thing to think about. So the final question, it boils down to can these companies pass on the rates or not, right? And in fact, I was just listening to the Arman con call, I think today or yesterday. um, they said this exact same thing, which is that if we increase it from 25 to 26% for the borrower, it's a marginal increase, right? Their borrower, and the reason, like you can think about why is the borrower willing to pay 25, 26%. Reason is where Arman works. It's a truly rural MFI company, right? Rural areas. वहां पे the only option is sahukar or money lender who might charge 100% interest rate or something, right? Very crazy, crazy interest rates. So actually, like I think like they're actually doing work of financial inclusion, which is why people are willing to pay that 25, 26%, and like they will happily pay 1 or 2% extra if they want to. Um, so I think like Ishmoit said, because these interest rates are going up, we have to understand the liability strength of different companies. There are companies who are able to raise CASA even in this bad environment, and then there are companies who are unable to raise CASA, right? I mean, especially in the bank side. I think those are the things you have to really, really monitor closely. I think one of the things which people were really surprised by or spooked by actually, HDFC, I think, raised some funds at 7.97% recently, right? I think that's very interesting actually, because like my home loan interest rate is 8.5%. So like if HDFC is borrowing at 8%, like what rate would they give it out at, right?
Right, Sahil. So there are questions around the use of technicals in your investing process, maybe for sell or buying a position. So yeah, any take on that, Sahil?
Like I'll be honest with you, like this is an area which I haven't explored very deeply. So I don't have very strong thoughts about it at all. I only have very ill-formed thoughts about it. My ill-formed thoughts right now are that especially for selling, I would be very skeptical to use. The reason is that people just sell mid cap and small cap just for the perception of the risk, right? They are not going to wait for the risk to pan out. They might start selling it even if there is no risk, just for the perception of risk, right? I mean, just take a few different examples. One good example of a company that I own here is Mirza. Mirza price fell like anything. Then when the results came out, now the price has also gone up like anything. I mean, in a couple of days, right? That actually shows you that, like, if you were selling on technicals, like, that would just make it, I think, a little bit harder for you, right? I mean, you might obviously buy back on technicals also, and there are people who do that, right? So, I mean, one clear thing, again, to quote Professor Bakshi, opposite of a good idea can also be a good idea, right? So for me, it doesn't make sense. But I mean, there are many other people. Like I don't know if I should name, but one of the seasoned investors I respect a lot. He also uses Techno Funda now, and he's like, if it breaks technicals, I'll sell it. If it starts rising again, I'll buy it again, right? But that's his process. So I mean, yeah, personally, I don't use it a lot, and I haven't explored the use too much. And the reason I'm slightly in two minds about it is, let's say it's somewhere in the middle for the buying, right? It's not at the perfect place technically. If I wait for it to come to the perfect place technically, it's like trying to predict the short term price, right? Ki in the next 1 month or 1 week, what might happen to the price? Is it going to fall more? Is it going to rise more? Another such example is Gujarat Fluoro. Again, it fell so much despite being a 30,000 crore market cap or like a very large company. This is not a micro cap. Gujarat Fluorochemical is not a micro cap. I would consider it to be a large small cap or a small mid cap, right? But it fell like anything, and then the results came, and now it has again gone back from where it had fallen. So my point is, like, mid cap, small cap ke andar this 30-40% volatility can come without reasons also, right? But at the same time, like, see, the thing is, I think one has to combine these things with valuations, right? And the overall market environment. So if you remember Sequent was correcting without anyone else correcting and at a high valuation. I think that might have been a good trigger to sell. कि मतलब technical plus valuation plus this is the only one who is correcting, no one else is correcting, right? That's a decent combination, because then you're increasing your probability of success or like correct decision making. Whereas if you look at like Gujarat Fluoro Mirza, they were not alone in correction, right? So many other companies are correcting not for a very major reason, but just because small cap and mid cap in general have been correcting, consolidating, however you say. I think you require more evidence. You can't just rely on technicals. That's like what I think.
Yeah,
So
fair
I'll
Sorry, I
enough.
just
mean,
add to your point over here. Uh,
yeah, please, yeah, please.
See, even there are actually tools available in technicals which will also help you to ride out this 20-30% volatility. And like it, I'll actually ask you to explore the space further in depth. You already have that technical analysis for long-term investors course, so you should actually watch it, because even in Mirza or Gujarat Furrow, there was no exit which got triggered through the tools. And in Web of Global, Sequent, Loris, DVs, all of these companies, exit got triggered after 5 years of holding, 3 years of holding. In some companies, there hasn't been any exit for last 25 years. Only exit was triggered during the great financial crisis. That's it. So actually, there are tools, and even in technicals, which can help you to actually streamline your exit, or at least force you to take a relook at the company fundamentally as well.
I think you're talking about V stop, right? If I understand
Right,
correctly.
right. There's one is that, and like another one is there. So V stop is probably the one that you should actually backtest and check.
Yeah,
Great.
yeah, yeah. Thanks a lot. Actually, like, just to tell everyone. Basically, Ishmoit keeps sharing these insights on the Telegram group he has for the tribe members. Like, unfortunately, sorry, Ishmoit, but I'm unable to watch all the videos. Like, some of them are like 9 hours long, and like I find it very hard to prioritize sometimes. But I obviously at least watch the Telegram group very closely, because it's like much lesser time. So that is definitely on my to-do list to check out VStop. So thank you so much for that suggestion.
Yeah, great, great. So Krishna, you have any other question, or shall I ask last question for the day?
No, no, go ahead.
So, Sai, like which interesting sectors or maybe investable pockets you are looking in this current market situation? So, yeah.
I think, like, see, the thing is, I personally don't have a very strong sector bias. What I definitely have is a bias for sunrise or like there has to be there's this concept of rising tide lifting all boats, right? So ideally, I want to be in a rising tide always at a portfolio level. Maybe couple of things might be contra or contrarian, where like I'm expecting the tide to rise after 1 year or something. Most cases I want to be in a rising tide, ideally a tide which is like a tsunami, right? So I would say, trends like solar manufacturing, um, uh, EVs, these are like tsunamis. They're not even a trend, they're a tsunami, right? This energy transition, manufacturing of electronics in India, again it's like a tsunami. If you go deep enough and look at what our ministers are saying, what the secretaries are saying, you will realize that suddenly the government realizes that this is one of the biggest things we have ignored for like 50 years, 60 years, right? In fact, famously, Mr. Narayan Murthy said, "Here we have missed the bus on electronics. We should not even try it." And Mr. Narayan Murthy, the respected founder of Infosys, felt, we have missed the bus. But then, like now, suddenly people realize that yeah, we can't miss the bus. Like even if we are late, we should maybe try to run and catch the bus or something, because this is just too large, too strategic an area for us to depend on imports from China and other countries. I think these are very, very mega trends. These are places we should definitely watch out very closely, especially if you look at these EMS companies, which like EMS is probably like the lowest value added type of electronics business. But even in this space, some companies like Dixon didn't have good results, but others like Keynes, others like I think Sirma had I think much better results. I think we have to do a lot of work to figure out like which ones to own. Although right now I don't own any of these EMS companies. Mostly I own more like component makers like Shivalik, like Xpro, and maybe others, but I'm not able to remember. Yeah.
Yeah, thanks, Sahil. So, any comments on the similar same question, Ismail?
What's the question? Sorry, I couldn't hear. I was just
I mean, interesting sectors or maybe investable pockets apart from the ones which you already invested in.
I think electronic manufacturing space is definitely one. I think there are like some like very small companies over here as well, 3-4 thousand crore market cap. So this is a space worth checking out. Another space worth checking out is definitely the hospital space, because some of the hospitals, if I just actually don't tell you it's a hospital, and if you just look at screener data and just look at the quarterly growth rate, just look at the EBITDA and the PAT growth. Actually, you'll be surprised that it's a fast-growing business and not a slow-growing one. So hospitals definitely you should check out. Then apart from that, something that you can check out again is in fluorochemicals is one space that you can check out within the chemical basket. अगर pessimism में देखना है तो pigment space is where very deep pessimism is right now there, because like your demand crashed but majority of these players expanded, and this has been the trend for last 17-18 years within the pigment industry. This is one sector worth checking out. Then banking and finance is also another sector. Cable and wires is actually like some of the players have grown there for like last 18 years. They've grown their volumes 15% compounded. So like I think one of the questions which Sahil like answered to earlier, ki it's very difficult to find companies which are not at high valuation, which have had these consistent growth. I think this cable and wire sector, uh, like these companies have had that consistent growth over last 18-20 years now, and multiples are still not out of whack for some of them. That is one more sector that you can study. Broadly, these are some of the sectors which I'm actually studying, focusing on, and yeah, this is where I think a lot of value is also basically visible at the moment.
Great, great. Thanks,
Also,
Ishmohit.
just to
So,
add one more, like some of the commodity companies, like which are expanding by 3 or 4x, they are actually, if you just do a FI 26-27 math, they are available at 1 or 2x EBITDA. So वहाँ पे भी like some if you get just one favorable cycle of margins expanding or one favorable cycle of commodity prices increasing, you are already at trough margins. So next 3-4 years में एक cycle तो ऐसा आ ही जाता है. So that is also one of the places if you want to check, so you can check it out.
right. So we got one more speaker. So, Sahil, shall we take the last question from him if time permits?
Yeah, yeah, please, please, yeah, please.
Yeah, Bala, you can unmute and quickly ask your question.
Yeah, good evening all. As a sectorial means we are discussing about sectorial. I have one sector. This air traffic sector. I think we can see a good demand over the coming 10-15 years. So we have very limited listed companies in this sector. Could you please throw some more light on this sector? Your opinion also on this one.
Yeah, hi sir. Thank you so much for reaching out. Actually, on the airline sector, I think like I was just looking at the data. India has 120 airports or so roughly. China has 250 airports. China, by the way, has bullet trains, a very vast network of bullet trains. I think it might be something like 80% of the Earth's bullet trains are in China, right? So vast network of bullet trains. That's one reason they have a smaller airport network. USA, which doesn't have bullet trains, I think they have something like 5,000 airports. It's like 50 times, 50 times the number of airports to India, right? So I think either, like, the one thing I want to sort of say very clearly, these are competing modes of transport, right? So the government is actually, I think, doing all three. They're building tremendous amount of roadways, like 40 kilometers a day. They're building tremendous amounts of railways, new capex, doubling the railway capacity, especially in freight carrying, right? And they're also building a large number of airports, right? I think even airports might double in the next, I think, 5 to 7 years. So definitely, this is a very interesting thing. In terms of companies in this space, I think like there's this one company which is into lounges, right? I think it's called Dream Folks. So that has always seemed like an interesting company to me. But to be honest with you, like when I actually studied it briefly, it was at a like higher valuation, right? So I mean, I had that it couldn't pass the valuation filter. But maybe like I should look at it again or something, right? I didn't go that deep at that point because it was at a higher valuation. I could find some other company to study which was at a lower valuation and stuff. But maybe I should relook at it. That's one interesting company because I think this lounges is another thing which is like an aspirational product. Like Indians think that going to lounges is like an interesting thing or a cool thing. Like even I like going to lounges, but like I mean, at least for me, it's like about like being kind of quiet. If the lounge is not quiet, I would not go there because like it's like sort of very what do you say disturbing if there's too much noise. But people don't agree with me, right? People are going for the free food. They're saying ki, my credit card is giving me a free meal, so I'm going to go and eat, right? And that works out perfectly. Um, so yeah, that's one interesting company to maybe look at.
Ishmoit, are you also tracking the same sector or any view on your end?
I'm not tracking the same sector, but I'm actually looking at some of the new age tech businesses where, like, I think the insurance aggregator space is one of the spaces which I'm studying very closely. I think Sahil might also be studying that because over there as well, globally, like insurance aggregators have 30 to 35% EBITDA margins, and specifically to this one, they've given a very clear pad bridge of FY26, FY27. But only game that I don't like है जो adjusted EBITDA वाला है कि X of ESOP cost देखो, which probably sounds funny. We are actually coming out with a thread of all like we are going to come out with a thread on Twitter. All the companies which have been making adjusted EBITDA adjusted to hyperinflation as well. One company actually had an adjusted lease expenses EBITDA reporting mechanism, which I was stunned to see. So we'll be taking out those examples as well. But yes, insurance aggregator space is one of the spaces which looks interesting because the said company has like already established themselves with 85-90% market share, and they're just selling health and life insurance, which is like 75 to 77% of the basically product mix for them. So that is one space in addition to all the previous basically themes we basically discussed at the moment.
Yeah, right, thanks. So, Sahil, like we are done with the questions, and thank you so much for your time. So, before we part our ways for today, so any closing remarks on your end or any 2 cents on my spaces?
Oh yeah, thanks, Prince Bhai, for having me. And I really enjoy your spaces. I try to attend the ones that I can, and I think you're doing wonderful work. So thank you so much for doing this. I think closing comments are just that I think like people should, sort of be very careful with their money. Try to spend time. You might think that you can only work 8 hours in a day, but I think that's like mental restriction we put on ourselves. If we try to extend ourselves slowly, it might, eventually become 10 or 12. And that's, in my opinion, that's all you need. And that's the difference between, I mean, just to give you a statistic, I had shared this interesting, I think, some Twitter thread where, like, the first tweet had, I think it had like 20,000 views. The last one had 100 views, right? That itself shows you, like, that, I mean, if someone is willing to just read the complete Twitter thread, which is like 15-20 minutes, right? I'm not even saying 2 hours. You are already ahead of like 99% people or like 95% people who like just saw the first tweet. So I think there's tremendous exponential value in going deep into any field actually, because most people won't go deep. So you can create that differentiation basically. So yeah, I hope everyone is able to go deep in something, if not investing, then their own fields at least.
Yeah, great. Thanks, and a great message to end with. So, Ishmoit, any quick concluding remarks from your end as well, and thank you so much for joining in along with and sharing your insights.
um, Actually, like wonderful session by Sahil and by you. You've done so many sessions now, so like every now and then when I'm basically driving, so like open your YouTube channel to listen to some session. So from my side, I think as active investors, position sizing and your understanding of business, and actually marrying the position sizing with risk reward, and at the end your understanding of business will be the key criterias which will basically determine your output on a portfolio level. And because we are entering a high interest rate environment, तो थोड़ी सी एक्सपेक्टेशन टेम्पर कर लेना जो लास्ट 2-3 years में हुआ था, हो सकता है वो ना हो गोइंग फॉरवर्ड. सो टेम्पर योर एक्सपेक्टेशंस, because if interest rates keep increasing, then definitely equity markets can go in a sideways trend or a downwards trend for a while, because आपका discount rate or cost of capital will end up increasing. So temper your expectations, because sometimes like 2017 to 2019 markets also happen where nothing works in spite of even you picking basically excellent or good businesses. So that is from my side, Prince.
Great. Thank you, Ishmoit, once again. And like guys, as Sahil was explaining, like the name of the company is 5%, and there is 95% work behind which you have to do your self, or maybe if you are taking somebody's advice, a registered advisor basically, so that can help you save your money. Don't go blind, and please take our spaces as purely educational spaces, and any name propped up during the conversations are purely for illustrations. There is by no means any buy sell or hold recommendation, and if you end up doing that, so you'll be risking your money, as simple as that. And thank you so much, and keep showering your love. So if you're liking our work, you can write to us, and if there is any feedback, positive, negative, balanced, you are more than welcome to write to us. And in case we missed out on any questions, so relevant questions, you can also DM or maybe tag Sahil, Ishmoit, or you can also tag me, so we try to get the answers for your questions. Thank you so much, and surely we will connect soon again. Thank you, Ishmoit. Thank you, Sai. And thank you, Krishna,
Thank
for
you.
your questions. Yeah.
Thank you, everyone. Thank you. Bye.
Thank you.
Answer, 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 answer,